retracement is not perhaps extraordinary. The world was over-allocated to the US. So again, reallocation out of the US at the margin, not in itself the sign that the old regime is breaking. But there are lots of warning signs here. And of course, the subtlety here is that if there is even a significant risk that we could be looking at an economic regime change, then that is going to affect asset prices today, well in advance of when we discover whether the regime is actually shifting or not.
Okay, so Krishna, let's game out what it would look like if, to use your phrase, we did see a real Liz Truss type moment in the United States with a real loss of confidence, both in Fed independence as well as policy certainty going forward in the United States. What would that look like in terms of asset prices going forward?
Well, so what I want to sort of point to here is, to begin with, that the starting position is very different, right? The US is not the UK. The US is the core holding in every global investor's portfolio, is the core holding in every official sector portfolio, the dollar dominant currency. So it takes a lot more to generate the type of Liz Truss dynamics in the US than it did in the UK. And we're definitely not there yet. But what would that pathway look like, right? That pathway would essentially involve morphing from a tariff crisis to a fiscal crisis. And the mechanism by which that would happen is a global buyer's strike in the Treasury market at the time when the deficit blew out on an economic downturn, lack of serious fiscal consolidation in tax legislation, and potentially even some doubling down on unfunded tax cuts down the line to try to pull the US out of that recession. To be really clear, that's not my forecast. It's not even my main risk case. My main risk case is a garden variety recession. But it is more than a tail risk at this point already. And if the Fed chair were to be fired, I think the risk of that morphing from a tariff crisis to a fiscal crisis would move up a lot.
You keep saying we're not in a fundamental regime shift yet. We're not at this Liz Truss moment yet. So the catalyst for you might be something on the fiscal front. Well, what happens when the tax negotiations become the new main driver and the president is pushing for more than just TCJA?
So I think the area that we all need to be focused on and thinking about is the interaction between the trade policy, the tariffs more broadly, pulling back from international economic and security engagement on the part of the US, and the fiscal front, where the US is already running a large structural deficit. And as you point out, there's tax legislation moving through that looks at this stage unlikely to tackle serious fiscal consolidation, with pressures to add more tax cuts, to what is already in the hopper. So as every economist nerd will tell you, a trade deficit is simply a capital surplus. And so when you start to pull away from international economic engagement on the trade side, it almost inevitably is going to have consequences on the capital account side as well. And that's where we've got to be careful, because a good part of that capital is funding the US deficit.
Krishna, looking forward to continuing the conversation with you, sir. Brilliant, as always. Krishna Guha there of Evercore. Up next on the programme, we'll catch up with Steve Orth of Federated, Alex Rosta of the Cato Institute, Lord John Brown of General Atlantic, and Mike Pyle of BlackRock. The second hour of Bloomberg Surveillance, up next. Or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days.
There's no way yet to gauge the impact of these policies. We'll see what happens, but it's not good.
We're going to have to see how this really translates into less demand for dollar assets.
The economy is on solid footing, but I think the question is, does that even matter with tariff levels this high?
We haven't had this before. This is an attempt to rewire the global economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Things shaping up in a more favourable way for those of you looking to take risk. Equity futures positive by 0.9% on the S&P, up by 1% on the Nasdaq 100. In the bond market, yields were higher by close to double digits across the curve at the long end yesterday. This morning, we're settling down just about unchanged on 10s and 30s. In yesterday's session, a big feature of what we witnessed, dollar weakness. This morning, just a touch of dollar strength. Euro dollar negative by 0.25%, 114.85, and a lot to look ahead to, including Tesla earnings after the closing bell. And this morning and throughout today, a ton of Fed speak. And the Fed speak, Lisa, gets more interested by the day.
Big question is, how much are you going to push back if President Trump tries to fire Jay Powell? How much are you going to try to essentially keep him in that position and hold on to your position? There's a real question here about how much this is real versus jawboning. And then there's an additional question, which is how much is just the jawboning alone doing enough damage to really undermine the confidence in ongoing policy in the United States? And that, I think, is a longer-term question at a time where people still haven't decided or figured out just how much this market is a check on President Trump.
Well, Trump continues to double down, though. This started on Thursday. We talked about the termination of Fed Chair Jay Powell, and he reiterated yesterday how he was annoyed with Jay Powell and that he should be going for what the Trump says many are calling preemptive cuts. But I love what RBC came out and said this morning from Blake Gwynn, the fact that actually Powell in place is a convenient scapegoat if there is a downturn in the economy and there is consumer and business frustration, which we see in survey data and CEO calls when it comes to tariffs and their inability to plan.
To your point, I think yesterday some people got the sense that the president was looking for a fall guy, and that fall guy was Chairman Powell.
Which is the reason why some people don't take it as seriously. Nonetheless, there is a real question about whether he will go through with it. The lack of predictability, I think, is causing some jitters right now. And frankly, or yippiness, I should say. The issue that I keep having is how much are we looking at a Brian Gardner view of the world, which is what you raised, which is a potential reordering of the trade sphere, versus a negotiation with a check that ultimately will be the bond vigilantes that are, James Carville's soul when he dies.
And Mohammed said it just there, a rewiring of the global order. Look, we're used to uncertainty. That's a feature of markets. There's nothing new about that. Or risk. You're meant to manage risk. But we usually manage risk within the rules of the game. And we understand the rules of the game. We also understand how institutions will respond to certain factors, certain catalysts, certain things that happen. I think now we're rethinking the rules of the game. That's a different moment for market participants to be in. And I still sense the confusion from people coming on the program trying to figure that out.
Confusion also from the companies that are reporting earnings. You talk about Tesla, fascinating to sort of a poster child for this, given the sort of dual role of Elon Musk and the company as an international player. We heard about what? The tariff premium or tariff uncertainty of about 20 cents when it comes to 3M. All of the companies are trying to understand how to game this out, and they can't either, which raises the question about long-term damage just based on the uncertainty that we keep getting.
The market is really thirsty for the rules of the road. And the issue you have right now, say, take it the Jay Powell question. Scott Bessent says that monetary policy is a jewel box that needs to be preserved. Meanwhile, Kevin Hassett, the NEC director, comes out and says, well, this is something that the president and his team is studying when it comes to whether or not he can legally get rid of Jay Powell. There are no rules, and depending on who you ask, you can lead down a different pathway.
Equity futures right now on the S&P positive by 0.9%. Some stability in the bond market for now. We'll see if that holds. Coming up this hour, we're catching up with Stephen Orth, the Federated, on navigating through the fog of trade uncertainty. Lord John Brown, the former BP boss, on the outlook for energy, and Mike Parle of BlackRock on diversifying beyond US assets. We begin this hour with stocks bouncing back following Monday's sell-off. Steve Orth of Federated Hermes writing, we're sticking with our now moderate equity overweight, waiting for a sign that the fog of uncertainty hanging over the market is beginning to lift. Good news, we might be getting closer. Stephen joins us now for more. Stephen, good to see you, as always.
Likewise.
Last time we spoke to you, you said, strap yourself to the mast and get through the storm. I think we learnt on some Greek philosophy from way back in the day. What do you do if the captain is trying to sabotage the ship?
Yeah, I mean, at some point that during, I think the week of the 2nd, I had a piece I was writing that I then trashed, saying, oh my gosh, he ran us into a reef on purpose. Look, I gotta believe, I get this existential risk stuff, but when you're in a storm, I think you try to look out a little bit further and say, okay, where is all this heading? And remember, it's not just President Trump, it's the markets, it's the U.S. consumer, it's the Chinese saver, there's a lot of cultural and economic structures here that will hold together. It's not going to all just come apart. And where are we going? I think at the margin, we're going to probably have a kind of national sales tax in the U.S., call it 10%. Some of that's going to get paid by somebody else. We're going to have, with our other trading partners, less tariffs, most likely. That's what we're negotiating to. But we're not going to end up with the U.S. in a trade surplus. That's not going to happen the way the U.S. economy is set up. So I see a distant future here where we've got some tax cuts coming through. We're working with a national sales tax that we can deal with. It's about 1% of GDP. Some of that's offset already by the lower, lower inflation rates. The bond market should settle down. And so what we've done is we said, okay, let's hold on to our modest equity overweight. Let's not get too out over our skis here. There's certainly the existential risk camp. And when he does stuff like, yell at Powell, maybe to make an excuse for how things are going, someone has probably explained to the president by now that there's 14 members of the FOMC, and getting rid of Powell is not going to change a darn thing. So in the end of the day, that's just, I think, bluster. And so we just sort of work through it, and we look for these 5 milestones. And each milestone that hits, I'm going to get incrementally more bullish. We have some dry powder to add here, and we're leaning into value stocks. Another big advantage that no one talks about this market is everyone says we came into the market overvalued. That's not really true. We came to the market with the Mag 7 overvalued. But there's a lot of stocks in the U.S. market that are trading at 9, 10 times earnings, nice dividend yields, very defensive, and they're holding up reasonably well in this market. And certainly all of Europe was on sale entering into this. The euro was on sale. The dollar was overvalued. So a lot of these things are correcting, but the market has some strengths here. And the banking system, by the way, I would add, is in very good shape. And that's why the credit markets haven't started to come apart.
A ton to unpack there. There was one phrase you used. The bond market should settle down. What's the strategic anchor that underpins that view? Where does that confidence come from?
It's just partly because the president will react if it doesn't. One of their key objectives is to get the 10-year yield down. They know that that's key to getting the mortgage market restarted and the housing market. And we saw what their pain point is on April 9th. The bond yield went to 4.5. Boom. Bessent's in charge. Navarro's off stage right. And, we're into negotiating these tariff deals. And he kind of clarified, okay, really 10% is where I'm heading.
How easy is it to discern some of the noise that we're seeing around policy uncertainty from some of the cyclical changes that we're seeing that are undermining some of the pillars of U.S. equity performance? You mentioned Mag 7. Overnight, Amazon reportedly paused some data center leases, which just builds on this fear that maybe we got ahead of our skis with the AI adoption story. Yeah. How easy is it to parse out policy uncertainty, existential risks from real shift in terms of the business cycle in big tech?
It's not easy, Lisa. Of course not. That's what, a little humility in this business goes a long way. One of my expressions at Federated Hermes has always been humility at the highs, confidence at the lows. No one has all the answers to this market. That's why you sort of navigate you through. You never go all in. And, I don't think it's easy. I think it's particularly difficult now. But in moments like that, when what has paid off for me, excuse me, is to look out a little bit more distant. Because when you get lost in the fog like we are right now, you can overly focus on every incoming. In the end of the day, the system will adjust backwards. And we started out reasonably strong. I mean, thank goodness. I mean, what if the banking system was stretched and capital ratios were low? Then we could really get into some existential risk issues.
You talk about barbelling it in a way, or that's sort of my inference from what you said.
Absolutely,
that there is
we're
this
barbell.
Sense, so you're barbelled. Is the barbell with cash and not necessarily treasuries? Because even though you do believe that fundamentally there will be a settling down, you don't want to depend on it, at least in the near term?
Lisa, if you ever need another job, give me a call. That's exactly how we're barbell.
All right.
We're overweight cash and we're underweight bonds. Our idea is, you're making 4.5% in the money market funds. Tom Keene's famous triple levered money market fund, which is finally working out for him.
Good place to be.
Yeah, and that's kind of why be in the 10-year bond. And so to us, have the cash at the side and use it to incrementally make adds to equities. We added at 5,400. We got 5,000 as our next target. 4,500 could be after that. I don't know where this market's going to bottom out. I don't think anyone does. But I think longer term, I can see a path to 6,000 pretty easily. I mean, we're going to get back to $300 in earnings.
You keep talking about longer term. You talk about it's often darkest before the dawn. Is that end longer term, looking through the fog, the entire Trump policy? How much are you betting on making sure there is deregulation in this economy and that TCJA gets extended?
Yeah, I absolutely. As an example, Anne-Marie, I mean, the SLR rule, right, which has been, Jamie Dimon talked about that last week. That's been holding back the banks as a buyer of treasuries. That's an obvious. I think we're going to see that very shortly, right? And that'll free up bank capital, help offset the decline that Krishna talked about. There's going to be a decline in foreign balances of U.S. treasuries if you really do cut into, at least I would say what he's trying to do is cut into the growth of the U.S. trade deficit. Remember, we were on an unsustainable path. This thing was just going inevitably higher. So he's trying to slow the growth, maybe pull it back some. That's going to put down some demand for U.S. treasuries. You replace that with the SLR thing. So I think the chaos somewhat increases, and that's why it's on our list of milestones. a deregulation should start to pick up pace. That's a lever they can pull to help markets. The tax cut bill is going to have to pick up pace. That's another layer they can prove. And yeah, they're going to have to stabilize the Treasury market or nothing else is going to work.
I've been through quite a few growth scares with you over the years. You've been long, strong, and right for quite a while, so I'll give you credit for that. Just a final question.
Thank you, Jonathan.
What's the tell? How will you know if you're wrong this time and you need to change your mind? What are you looking for? What's the tell?
I'll be asking Lisa for a job.
The other way around.
Yeah, look, you know, I would say if the 10-year goes a lot higher than 5, I think 5 is reachable for sure. And I would expect some real policy reaction at that level. If we sail through that, that would be a sign, gee, we have a bigger problem here than we realized. But the banking system would also have to come apart. I mean, one of the first people to speak at our Monday morning meetings these days is my credit guys. Because they're watching the credit markets. And okay, they did, you know, credit spreads started to open up some relative to where they've been the last 3 or 4 years. But they're nowhere near.
But is that really the benchmark, the threshold to get bearish on stocks, that the banking sector needs to come apart?
Yeah, because what you're talking about is existential risk and the whole economy collapsing.
No, not necessarily. I'm trying to work out what would make you bearish on equities. And I don't think it needs to be the existential risk manifesting. It can be something else.
Yeah, it's hard to get me long-term bearish on equities because if you own equities, and this is sort of Warren Buffett view of the world, you own a set of very strong companies, some of the best in the world, that inevitably grow their revenues and earnings over time. You're not just owning a kind of ticket at Las Vegas here. You own a share in the global economy. And as long as it keeps marching along, some of the greatest companies in that economy are here in the U.S.
Yeah.
They keep marching along, and the earnings inevitably go higher, and the value of those companies goes up. It's not voodoo why stocks go up over time.
It's felt like a casino over the last month, that's for sure. Steve,
yeah, it's felt like a casino.
Steve, thanks for
dropping by. Take a couple
by.
of value.
Stephen Orth, Federated Hermes. Steve, thank you. Just a programming note. At the end of this hour, Lisa is going away for a interview a little bit later. She's not getting the job with Steve, all right?
And I'm not taking a cup of Valium either.
Don't try that again, Steve. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Verizon shares trading more than 3.5% lower in the pre-market. It reported a loss of more phone and internet customers than expected. Verizon topped estimates on operating revenue and adjusted EPS, but saw a 15% loss in Fios internet subscribers from last year. It also reaffirmed its full-year guidance, but excluding the impact of tariffs. U.S. VP J.D. Vance spoke in India earlier this morning after meeting with Prime Minister Narendra Modi. Vance said that the U.S. wants India to drop non-tariff barriers and looks forward to stronger ties with the country. Previously, the U.S. reported that it made significant progress towards a bilateral trade deal following talks. Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Harvard's president said the freeze happened after it refused to follow illegal demands to make changes to governance, discipline, and hiring policies, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. And that's your brief, John.
Danny, thank you. More from Danny later on this hour. Up next on the program, the president still bullish on the U.S.
The economy is very good. We don't have inflation. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
Up next on the program, Alex Anorasta of the Cato Institute, live from New York. This is Bloomberg.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equities firmer this morning, up by 0.8% on the S&P, likewise on the Nasdaq 100. And a surveillance this morning, the president still bullish on the U.S.
We're going to ultimately have a deal with anyone. The economy is very good. We don't have inflation. Energy's down at the lowest it's been in years. We hit actually $1.98 recently in a couple of states. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
So here's the latest this morning. President Trump remaining optimistic on trade negotiations after warning the U.S. economy may slow if the Fed chair does not cut interest rates in his latest criticism of Chairman Powell. Joining us now, Bloomberg's Tyler Kendall, live from Washington. Tyler, we've heard a few times, on a number of occasions over the past few days, that things are progressing with the likes of Japan and India. But we've had no real details on why people think things are progressing. Can you point to any?
Hey, John. Well, President Trump himself says that there is progress when it comes to these negotiations, but that he needs a little bit more time. And it does appear that those countries that the U.S. said it was prioritizing are the ones that we are talking the most about when it comes to any progress. And Vice President J.D. Vance actually made a few headlines last hour speaking in India after the White House put out a readout saying that significant progress was made, including a finalized roadmap that could potentially lead to a deal. J.D. Vance, though, doubling down on the idea that the U.S. really does need to see non-tariff barriers included in any such agreement. We know India, of course, had moved to slash much of its tariff regime ahead of April 2nd, has also pledged to cut import taxes, for example. But this White House would really like to see some firmer commitments when it comes to boosting U.S. imports, particularly LNG, as well as high-tech defense equipment. And I'd say that India, of course, is one of those countries that the U.S. has largely seen as a way to shore up relationships and a bid to counter China. And another ally in the region, Japan, as you mentioned, also getting priority in these talks here. It was confirmed that Treasury Secretary Scott Bessent will be meeting with his Japanese counterpart here in Washington, the latter of which confirmed that they will be talking about foreign exchange rates. That was considered to be some positive momentum because it was our understanding that Japan was not interested in talking about currency during these talks. And so, John, really still a lot of uncertainty here, particularly about the timeline, particularly about exactly what the White House needs to see in order to clinch a deal. But I'd also just quickly add that we're watching not just the countries trying to engage with this White House, but also the private sector. Bloomberg News was the one yesterday to break that story that some major retailers visited the White House, including Home Depot, Lowe's, and Target.
Tyler Kendall with the latest down in Washington. Tyler, thank you. So on the one hand, we've got trade uncertainty. On the other, we've got threats to central bank independence. Joining us now to discuss, Alex Norrister of the Cato Institute. Alex, welcome to the program. This is what you had to say on the Fed. If they were controlled by the president, rates would fall, inflation would spiral, growth would stagnate, a disaster. Ultimately, that seems unlikely, but we should all be vigilant to that possibility. Alex, why do you think it remains somewhat unlikely?
Remains somewhat unlikely because the law is fairly clear on this. The ability of the president to remove and replace the chair of the Federal Reserve at whim seems to be outside of his power. This hasn't been tested, of course, in the last 112 years of the Federal Reserve system existing, but it seems fairly robust. Alex. So, you know, this president surprises us all the time, right? But I think the law is probably on our side here.
So when it comes to ousting Jay Powell, though, do you think the president is doing this to actually have a scapegoat if his tariff negotiations don't go as planned?
I think there's no downside for President Trump politically for challenging Chairman Powell. If he doesn't get what he wants, he doesn't get a new Fed chair, then he can always blame it on him. If he does get what he wants, then he has control over the central bank of the United States, which can help him politically. So there's really no downside. Of course, the major downside is on the U.S. economy if he succeeds. If he succeeds in getting power over the central bank, ending central bank independence in the United States, then you'll have those negative economic consequences that I talked about: higher inflation, lower growth, more political and economic uncertainty. But if he doesn't get control of the Fed, but he just threatens it, then there's a chance that either Powell or future chairman of the Federal Reserve will listen more to the threats of politicians like they did in the 1970s when we had stagflation, and then we'll have just poor economic outcomes going forward.
Alex, where is Congress in all of this, both when it comes to tariff and trying to wrangle back some of the control on tariff policy, and also when it comes to Fed policy? Jay Powell does have a boss. It's Congress.
So I have been asking where Congress is for basically my entire career on almost every issue. I mean, the long-term trend for Congress is to pull back its power and to grant more and more power to the president. So Congress is not like a dead institution. It's not a dying institution. They make noises sometimes. They introduce legislation to try to rein in the president. There was recently a resolution introduced by Senator Powell to reduce the president's power to set tariff rates. There are numerous challenges in the courts saying that no, Congress has this power, but ultimately it's very difficult to make Congress exercise its power if it simply doesn't want to. And what we are seeing right now is a Congress not taking up its powers or responsibilities to either rein in the president or to govern. They are focusing importantly on the tax cuts bill. They're focusing importantly on the Tax Cuts and Jobs Act, extending that. But outside of that, they are not considering major pieces of legislation or getting a wrangle or reins on this president.
Will that change? Will they become more vocal as we head into the midterm elections?
They probably will. Now, for Republicans who control, the House, of course, being more vocal is dangerous because the head of their party, of course, is President Trump, and he is in charge. And sort of the cause of a lot of this economic uncertainty is his arbitrary wielding of power. So they face a dangerous trade-off there. But moderate Republicans, I think, will definitely start to step up and try to distance themselves from the president if the economy gets worse and it looks like a terrible midterm election for them. Democrats, of course, will always be out there criticizing President Trump, no matter how good things are or how bad things are. But they will probably be louder if things get worse. But they might be louder in the sense of if the Republicans saying, well, this means that President Trump means more power. So that doesn't necessarily bode well if they start to be louder.
What a moment. Alex, thank you, sir. Alex Nowrasteh of the Cato Institute. Equity futures right now in the S&P doing better. If you are just joining us, welcome to the program. Equity futures up by 0.8% in the bond market. A sell-off yesterday at the long end of the curve this morning. Yields just a touch lower, down by 2 basis points on 30s. Similar move on a 10-year, down a single basis point. And in foreign exchange, just a ton of dollar weakness. The dollar heading towards one of the worst months we've seen over the last decade. Euro dollar at the moment negative by about 0.2% to 114.84. So the dollar making just a little bit of a comeback as well. Up next on the program, we'll talk energy. We'll catch up with Lord John Brown of General Atlantic from New York City. You're watching Bloomberg TV.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equity futures on the S&P doing better, positive by 0.8% on the S&P 500. On the Nasdaq 100, up by 0.85, with 2 hours until the cash open. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. We have some earnings to get through, and you'll be hard-pressed to find companies that aren't talking about Washington in their earnings. Verizon shares down nearly 4 1/3%. They had a larger loss on subscribers for their internet and mobile phones than they had expected. Now, part of this is about competition, but I should say their competitor shares are also falling this morning. The other, maybe more interesting part is that federal spending on these phone plans has been pulling back significantly for them, as we've seen the DOGE cuts in both costs and jobs. So those shares down this morning. Kimberly-Clark also reporting, and they are lowering their expectations for the year. Those shares down more than 3%. The CEO saying that their assumptions for costs are going to be higher than they had assumed at the start of the year because of tariffs. Now, it does imply that they're going to be eating some of the margin, and hence you get the reaction in the share price this morning. Again, down 3.2%. Finally, wrapping things up with GE Aerospace. They've actually maintained their outlook for the year, and that includes the tariff outlook. So those shares up 2.6%. They said that their forecast assumes that there's no tariff escalation and no recession. Would be interesting to know what exact numbers that they are using for their calculations, given we don't have the final numbers on things like reciprocal tariffs yet, and that a lot of their customers on various airlines have reported some potential issues to come. John.
The clock is ticking on negotiations on the trade side, that's for sure. Danny, thank you. More from Danny later this hour. On our radar this morning, President Trump continuing his attacks on Fed Chair Jay Powell. Trump saying there can be a slowing of the economy unless Powell, a major loser, lowers interest rates.
So he's doubling down on his jawboning of Fed Chair Jay Powell. The issue is, of course, does this stop at just jawboning him to try to lower interest rates and really, as RBC calls it, using him as a scapegoat? Or does he actually try to meet with advisors, as Kevin Hassett said, and really think about ways they could get rid of the Fed chair? And if that were to happen, the pushback on the markets would, I think, be brutal based off what we saw yesterday.
I'd just like to state that that was a direct quote, not my words. Powell, a major loser.
Yeah, well, to me, I'm just wondering, let's say they cut rates to zero. Let's say that they do. If they're targeting the 10-year, what happens to the 10-year? Is that a positive thing? At this point, the market is saying, if you get what you want, well, you're not going to get what you want. So this is going to be a very interesting moment about who gets the ear of the president and whether this is a reflection or whether this is just scapegoating Mr. Too Late. You know, it's his fault.
Do you know what I hear consistently from the bulls on Wall Street? They believe the policies are so extreme, they're self-limiting. You hear that repeatedly. They believe that in the bond market, you'll get the constraints. Yields will push back. They'll have to back down. Same with trade, the equity market. I hear that repeatedly.
You know, I'm actually sympathetic to some degree, because if you take a look at the polls in terms of the favorability of the president, they do suggest a check in terms of the midterm elections. You are getting lawsuits when it comes to certain places where people believe that the president has overextended his power. So there is an institution that you can't completely interrupt by making vast proclamations.
I want to turn to this story, an update on what's happening with retailers. President Trump meeting with retailers Walmart, Home Depot, Lowe's and Target. The talk's coming as businesses look to navigate higher tariffs. Spokespeople for the companies involved calling the meeting productive. I'm not sure they can say anything else at this point, can they?
Productive, another word they used was constructive when I looked at all the readouts from some of these companies and how their White House meetings went. Obviously, I think was most interesting, Target, Walmart, more than half their goods coming from China. But Walmart specifically, they're now in the West Wing talking to the president. A few weeks ago, our reporting was that they were in China talking to these factories saying, please cut your prices because we're not going to be able to buy as much from you and we don't want to pass on as much to our consumers. And the Chinese ministry then, the Commerce Ministry, called Walmart executives in and said, please do not go to tell us what to do. They are trying to stand tough. So Walmart, all these companies are square in the middle, and you see them almost ping-ponging between Beijing and Washington.
The fact that these executives from Walmart, Home Depot, Lowe's, Target have an audience with the president is actually really important because they're going to give the practical realities of their supply chain at a time where it's unclear exactly who's going to absorb the costs. It is interesting to hear Home Depot say that it works with administrations from both sides of the aisle and other people coming out and just declining to comment. Exactly what was said, who knows? The audience itself, though, to me is notable.
I think the Target spokesperson said they want to focus on offering Americans value, which I translated as cheap goods from abroad that we want to carry on importing without big tariffs. Now, whether they get to do that or not, I think remains to be seen. And we're going to see in the next few months.
It's a good question. In other words, are you willing to torpedo a massive U.S. company to try to restructure trade? And is he going to tell that to their face? It's interesting about whether, again, in this audience, how direct some of these conversations were, given the fact that Walmart is going to invest in value, which means that they are going to basically absorb the losses in their balance sheet and profit margins in order to keep prices the same.
Let's talk about that word invest. How can you make investment decisions right now? CapEx decisions. Amazon is pausing some data center leases in a pullback for web services and AI. Analysts at Wells Fargo cited discussions with several industry sources saying this could be a natural ebb and flow of hyperscaler activity. Now, this is something we've seen and heard a few times now in the last few months.
Yeah, Microsoft doing something similar. A big question here, and if you take a step back, and this is what Steve Auth was talking about, how do you decipher what we're seeing with policy noise and the ebbs and the flows of maybe an AI supercycle that got maybe overpriced a little bit in the markets? That's an interesting kind of analysis that this just adds to. If you get Amazon pulling back, does this mean a wholesale retrenchment, or are we just seeing the luster lost from the AI promises and then a reinvestment later this year when everybody really needs it again?
What did the Treasury Secretary Scott Bessent say to Anne-Marie a few weeks ago? We got a Mag 7 problem, not a MAGA problem in the equity market. He was talking about DeepSeek and some of the revelations in this space over the last few months.
He was talking about the fact that that is why you saw issues like the tech companies that are not doing so well in the equity market. The issue is, of course, you see the S&P 500, the Dow, they're all suffering since Trump's inauguration. I think most investors would say it's not just a Mag 7 problem. It's a little bit of a MAGA problem as well.
They've got a bigger problem than that, that's for sure. We are bouncing back this morning. S&P 500 futures up by 0.8%. Let's talk about energy. The US imposing new levies of over 3,000% on solar imports from countries in Southeast Asia. The move delivering a win for domestic manufacturers while intensifying headwinds already threatening the country's renewable power development. Beyond net zero, co-founder Lord John Brown writing, the energy transition is no longer a rising tide lifting all boats. It is becoming a more complex, fragmented investment landscape and requires sharper focus and strategic capital allocation. Joining us now, the man himself, Lord John Brown. John, it's good to see you, sir.
Very good to be here.
How much harder is it to make plans for cross-border investment in a time like this one?
Well, the uncertainty is so high that the answer is very difficult indeed. So you're going to use what you have in inventory, see what you can buy locally, and keep going where the IR, the internal rate of return, is satisfactory and gives you clearance above your cost of capital. As always in business. So a lot of things will be changing. A lot of things will be changing in the United States. The world outside the US will carry on in a very different way.
Well, let's talk about the United States and the differences to the rest of the world. You know the supply chains far better than I do. Can you fully domesticate supply chains here in the United States to achieve the transition that people like you would like to achieve?
You could, but it will take an awfully long time. I mean, when you're setting up a factory to do something, getting all the raw materials in place, it doesn't happen overnight. This is way beyond an electoral cycle to get this done. So it just takes time. In the end, there has to be some way of getting what you can call a win-win situation, even though the philosophy here appears to be self-sufficient, to have manufacturing in this country, and to have everything under the control of the United States. That is a very difficult thing to achieve in almost anything to do with energy, with the single exception of natural resources that you own, and then you can do something with them.
It feels like we're stuck between two extremes at the moment. On the one hand, entirely dependent on things coming out of China, and on the other hand, bringing all these supply chains back to the United States. Is there something in between? Is there something we can do in between?
Well, there is, of course, brand new sets, different sources of energy. So have a revival of nuclear, for example. Create lower-cost nuclear if you can get there. In fact, use more natural gas, which is what I think the big theme of today is. If you can find enough turbines to power up to make electricity. And there the supply chain, again, is very, very tight. Being enhanced in the US at the moment, but again, that takes time. So turbines are sold out until probably the end of 2028. So again, long term, energy doesn't move on a dime. It moves very slowly because it's very high capex and requires very complex supply chains.
There's a question then about how much President Trump's policies can derail some of the renewable energy investments that we've seen around the world. In particular, your former company, BP, which has made a real big point of transitioning. Has that been undermined in some capacity with some of the moves away from those policies by the Trump administration?
I think day to day, yes. But when you look at the world outside the United States, it's very clear there's a lot of momentum behind reducing greenhouse gases. And you see it every day. You know, Japan's just announced it's taking to the diet a new idea on carbon credits and carbon trading. The World Shipping Organization is going to try and reduce emissions from ships. And a lot of people are still investing. But they'll invest at maybe a slightly different pace than they were doing previously, but they're not losing the big purpose. In the end, you know, the politics do not control climate change itself, and people want to control it. So, but the actors all change. I think the case of oil and gas companies is what you might call a very specific case. You know, in the end, oil and gas companies have to be at their heart oil and gas companies. They're very, very good at that. They find oil, they find gas, they produce it, take it to the market. And if they let that business go, then investors worry about what else they're going to do, because their skill base in doing renewable energy, all the other things, is not as strong as the oil and gas. They can do one thing, or two things. One is they can reduce methane emissions, which they continue to do, and secondly, develop new ways of doing carbon capture and storage using old oil fields and gas fields.
Political players change, and some of the rules of a game can change, but geopolitics doesn't change as much or as quickly, and I wonder how much this shift toward renewables outside of the U.S., let alone in the U.S., is dependent on materials and goods from China, which has centered itself as the main producer of solar panels, of so many of the renewable resources, and has a lot of the precious metals that go into all of these things. How easy is it to remove China from the shift toward renewables around the world?
It will be very, very difficult. But it's not the only place in the world with rare earths. It's not the only place in the world where you could, in theory, make silicon wafers to make solar panels. It just takes time. So, like everything, I mean, business seeks the lowest cost solution and the most stable solution at any time in its life. So it will continue to do that until such a time as it's not possible. In that case, we get derailed. But we have to think very carefully about supply chains. You know, one example, for example, is something which goes into certain types of nuclear reactors, highly enriched uranium. Turns out that about the only place in the world we could get that is Russia. And we were dependent on that. So that supply chain has to change. So all of this, I think, in a new geopolitics of different relationships, makes people begin to think what can happen. And there will be a check and balance. In the end, when things are impossible, the possible is found somehow. You know, that's what happens when it comes to business.
When it comes to China, though, how do you think officials should be viewing climate priorities versus national security priorities?
Well, it's a very good question that not everything is to do with national security. Obviously, people could argue that simply giving people $1 improves their bellicose nature. But that's not actually true. And provided that one is very careful about what is the relationship based on, whether it's secure things, not secure things, then I think you can carry on. In the end, of course, great powers have to keep to themselves the very central core of the castle, which is very important technologies of the future. And that, I think, will actually define the very nature of great powers. And so there is a lot of concern about that. I think making solar panels is not one of those issues.
John, appreciate your time, as always, sir. Much needed clarity on an important issue. Lord John Brown there on the energy sector. Thank you, sir. Appreciate it. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Pope Francis' funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. Plans to choose his successor are underway. The College of Cardinals will meet in conclave in about 2 weeks, with about 135 cardinals voting. The U.S. could produce one of the contenders, Cardinal Raymond Leo Burke, an ARC social conservative. 3M shares are racing earlier losses to trade higher by more than 4% in the pre-market trade. It reported earnings that beat analyst estimates. It also stood by its full-year guidance, but said it could see a tariff impact of 28 to 40 cents per share. Elsewhere, Bitcoin is also touching its highest level since early March. The digital currency has rallied almost 20% from its April 7th low after President Trump's tariff announcement. Bitcoin is now trading more like gold and has recently decoupled from U.S. tech stocks. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on. Up next on the program, upending the status quo.
You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
It is a bad scenario for the U.S. economy.
That all moves in the direction of slower growth, higher inflation.
Up next on the program, we'll catch up with Mike Powell of BlackRock from New York City. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The market doing better this morning so far. Equity futures positive across the board on the S&P 500, up by 0.8%. On the Nasdaq, a similar move. In the bond market, settling down, yields lower by 2 basis points on 30s, down a single basis point on a 10-year. Under surveillance this morning, upending the status quo.
You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
This just adds to another one of those walls of work.
Trump is trying to pass the buck to Powell for whatever market problems exist.
We think it is a bad scenario for the U.S. economy.
Concerns about political independence of the Fed, that all moves in the direction of slower growth, higher inflation.
So here's the latest this morning. Tariff uncertainty and threats to the Fed's independence, upending investor confidence and drawing capital away from U.S. assets. Mike Pyle of BlackRock writing, this is a moment where strategies that are more market neutral or factor neutral can shine. Strategies that are less dependent on the overall direction of markets to generate returns. Mike joins us now for more. Mike, good morning. Good to see you.
Good to be here.
Feels like a massive change is underway, and we talked about this repeatedly on this program, that maybe it's a shock not just to the cycle, but to the system and how we think about investing. How are you and the team thinking about those issues at the moment?
Yeah, I mean, I think your framing on that has been spot on. And I think one of the things that's really important to disentangle, and we don't have enough evidence to really come to judgments around, is clearly we've seen an unwind in sentiment around U.S. exceptionalism since the start of the year. I mean, that sentiment was probably in a pretty extended place coming into 2025. But I think there's a difference between an unwind in sentiment and something that's more structural and long-lasting over a multi-year period. And I think I would just highlight, you know, yes, there have been dents in that thesis over the course of the year, but there are still really important strengths in the U.S. model. You think about the quality of our corporate sector and the type of innovation and dynamism it brings. You think about, you know, and I thought about this a lot when I was in government, you know, just how durable the dollar is as a cornerstone of the global economy. These aren't things that play out over months, and I think that's why it's important to try to disentangle exactly your point, like what if this is just an unwind in sentiment and what can be genuinely more long-lasting.
What would be on your dashboard to help you navigate that? What would be the tell for you?
Yeah, I mean, I think that two of the things that we're, you know, keeping a close eye on as we think about the U.S. cycle economically, and I think that, you know, U.S. economic strength as we play this forward over the next couple of years is going to be an important component of that is, yes, this has been a significant shock and is going to be, you know, on growth, on inflation, but how big of a shock and how persistent, I think, is an ongoing question. Again, two places we're going to be looking at. One, the U.S. consumer. How does the U.S. consumer hold up? I think the data right now is pretty uncertain. On one hand, you know, I think we do see behavior on the good side that's suggestive that consumers are pulling forward a lot of demand to front run the tariffs, and we might see a significant fall off on the other side. On the flip side, you see U.S. consumers stepping into places like restaurant spending, like eating out, which is suggestive both of holding up and a shift of consumer behavior from goods to services. You know, that's the kind of question that I think is going to say, you know, is the U.S. consumer still the consumer of last resort globally? Is it still going to hold up? And that's going to be a big part of that structural picture as we roll the clock forward.
Another big part of that structural picture isn't just the companies and the strength of them. It's the strength of the U.S. debt market and how much you can have reliance on this idea that it is a stable, deep, liquid market when you've seen trades that resemble something of a penny stock. And I do wonder how much you can get excited about a 30-year treasury with a yield almost at 5%, or do you say this is no-go until we get more clarity on that story?
So I'd sort of say a couple of things. I mean, one, you know, I think that you actually highlighted overnight, Lisa, on Twitter, you know, an interesting evolution in who's buying Treasury securities, and that move away from foreign buyers to U.S. buyers suggests, you know, this isn't just a thesis about foreign investors reconsidering U.S. assets. It's a question about, you know, the overall attractiveness of Treasury securities. And I think there, you know, I just look to the basic, you know, bread and butter. What is the sort of forward path of U.S. growth? You know, what does the U.S. fiscal picture look like out over the medium to long term? I think on that question, we're going to get more more certainty as we move into the summer and fall about what that trajectory looks like and how much upward pressure we're going to end up seeing on term premia. I do think that our view at BlackRock is their pressures on the Treasury rates are going to be higher, particularly when we see, uncertainties around fiscal and other dimensions. But I think, to your point, this isn't just about foreign investors reconsidering Treasuries. It's about really looking at that bread and butter from U.S. investors and foreign investors alike.
It has highlighted, though, the question around diversification and whether that looks very different. And you talk about not having a market correlated type of approach. Has the story of gold as being the sort of key diversifier gotten overplayed, and that sort of really being a more complicated story than just that?
Yeah, I mean, I'll be the first to say I'm not an expert when it comes to gold. I think one of the things I've sort of looked at myself and said, this has clearly been a good trade for diversification, but will it be going forward? And I think one of the things that asset allocators have consistently cautioned around gold is, this isn't a yielding asset, and it's one that has had a big run up already year to date and over a longer horizon. I think that's why, to our eyes, strategies that have held up well in this market environment, things like quant strategies, like I said, more market neutral, more factor neutral, have really held up quite well year to date. And I think what they offer is return, income, diversification, liquidity. These are the types of things that investors are looking at. And I think that's one of the reasons why we've been advising clients that those types of strategies, those liquid alternatives, those hedge fund strategies are an important part of getting return, liquidity, diversification in an uncertain moment.
You sound constructive, though, right now. What's your advice to individuals who look at every single truth and see the market whipsaw and is trading on that moment, when you, working in government, know that a lot of this can take a very long time?
Yeah, I mean, I think that's one of the things that I've been thinking through. As you know, Anne-Marie spent a fair amount of time in the middle of trade negotiations, and I think on one hand, I think there's a fair amount of constructiveness out there that the administration can reach deals, out of the gate, perhaps within India or Japan, that sets a template for what additional deals could look like. But the part of me that served in government is a little more cautious. These are hard negotiations. Tariff issues are hard. In some ways, non-tariff issues, behind the border issues, are even harder. Oftentimes, they go to really sensitive political issues in the relevant country. And so, on one hand, want to see that template for what a trade deal, but on the other hand, I'm cautious on the timeline that can play out, because these are hard discussions and hard negotiations.
Are you happy you're not in Washington this week?
I am happy to be right here in New York City with the three of you.
We're happy to have you. Mike Powell of BlackRock. Lisa will be heading off to Washington very shortly. Looking forward to your conversation a little bit later.
Yeah, we're going to be speaking with the IMF Managing Director, Kristalina Georgieva, and I love that. Mike Powell comes in and he's like, I'm not there. It feels pretty good to be here, but I hear you guys are heading down, and it's going to be a lot of fun. I'm actually looking forward to it. I think it'll be really interesting.
Looking forward to hearing from you and from the IMF Managing Director a little bit later on this afternoon. Anne-Marie will catch up with Lisa and me tomorrow morning. Looking forward to that. Coming up, Tom Kennedy of JP Morgan, Tom Naran of RBC, former New York Fed President Bill Dudley, and Michael Kushner of Morgan Stanley. The third hour of Bloomberg Surveillance is up next.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked, if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is an attack on the independence of the Fed.
If there is a disruption to the Fed's independence, we are on a slippery slope.
One of the keys to the U.S. financial market is the independence of the Fed.
It's so obvious, the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible.
The end result is that we're all asking huge, major tectonic shift questions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away, and equity futures are doing okay, positive by 0.7% on the S&P 500, bouncing back on the Nasdaq as well. The Nasdaq 100 up by 0.8. In the bond market, yields a little bit lower. This brings you some comfort, I'm sure. We're down a single basis point on the 10-year. We're down 2 on 30s. A lot of doubts about U.S. safe haven status all over again in yesterday's session.
All over again, why? Because the president was doubling down yet again about how he's really angry, frustrated, unleashed yesterday once again on Jay Powell to lower interest rates. And everyone keeps coming back, Jonathan, to that Thursday post. When you and I are sitting here trying to make out what the president meant when he talked about termination, the end of Powell's term next year, actually trying to oust him. In the midst of the fog when it comes to tariffs, there's now this fog when it comes to the Fed. But today, there's a little bit of a reprieve.
It felt like he was looking for a fall guy yesterday. That one post where he talked about the possibility of the economy softening and then laying blame at the feet of the Federal Reserve Chairman, Jay Powell. Do you think there was an acknowledgement there, just implicitly, from the President of the United States that maybe we could be in for a soft patch in the not-too-distant future?
I think so, because he's looking for an individual, as RBC puts it, to scapegoat. And what better than the Fed chair, especially when you can try to politicize Jay Powell, talking about the fact that the Fed cut interest rates before the last election, saying that he was trying to juice the market for Joe Biden and then a la Kamala Harris. That is why this potentially is working. But Neil Dutta said yesterday in a fantastic post, saying this doesn't really make sense when they were talking about how the economy was doing well when they came into office. Now this doesn't really work, this flip-flop.
Yesterday, new lows for the US dollar. This morning, bouncing back. Euro dollar pulling back. Some euro weakness for you. 114.84 and that currency pair. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan as concerns over Fed independence weigh on US assets. Tom Narayan of RBC with Tesla earnings on deck. And the former New York Fed President Bill Dudley on the risk to Fed independence. We begin this hour with the dollar heading towards its worst month since 2009. headline. Tom Kennedy of JP Morgan writing, the dollar, as the world's preeminent reserve currency, is under siege. The dollar is depreciating as the stock market declines. This likely has traders betting that global flows towards the US will slow. Tom joins us now for more. Tom, good morning.
Good morning.
Good to see you. What do you think of what's happening with the Federal Reserve and the erosion of the safe haven status of the United States?
Economists will traditionally say the independence of the Fed affords America a couple of luxuries, but preeminently a stable inflation outlook and confidence that you can lend to the U.S. government for a long period of time. I think we're seeing an erosion of that confidence happen right now. It also has bigger knock-on effects throughout the economy as well, as the dollar is not becoming that safe haven asset. For the last 15 years, we've seen global investors just pour into America. About 30% of global flows or global invested assets are in the U.S. So in America, we feel like we're having some pain, but global investors, as the dollar depreciates as well, feeling even more pain, assuming they're unhedged. So that safe haven status is under siege, as I'm saying there, but also now it's creating these other ripple effects about how we do portfolio construction. Stocks and bond diversification. Like, you can look at past clips of your show, guys. Everyone trying to find that inverse correlation coming back. It's been over 3 years now. Inverse correlation, not there. It's a new era for multi-asset investing.
Let's unpack some of that, particularly the last point, which is incredibly important. Before we get there, I want an understanding from you. That dollar long that we've built up over the last decade plus across several asset classes here in the United States, both equities and fixed income, is this just a natural rebalancing of that, or is there something more nefarious going on here? Because that would take us to whether we really need to rethink about portfolio construction in the modern way we've viewed it over the last several decades.
Well, what's the pillar of a reserve currency? Is a deep liquid market we can all invest in? So that's really still there. Can we get in and out without moving the price? Yeah, I think that's still there. Confidence in the common law system as we know it? I don't think that's more confident today than what it was years ago. So there is some knock that's happening there. Your question is a great one. Is it a complete rewrite or is it an adjustment? I think it's got to be an adjustment in that this deep liquid pool of investing in America, there isn't anywhere else to really go with that. However, the market is voting with its capital where it thinks safe haven status is. There is no statistical model for gold now. It's not interest rate differentials. It's not driving gold at this point. And when you look under the hood of what's happening in gold, is it financial markets betting in the futures and options market? Not really. Volumes there are not at all-time highs, yet we know prices are. So it's real end-user investors finding a new diversifier. I think that's the game as we move forward. Marginally, what's the best diversifier? Is it gold? Might be. Could it be Bitcoin? Maybe. Could it be things like real estate and infrastructure? I'm betting it's going to be those as well.
The market's voting. You've clearly got a view. What do you think it will be in the years to come?
I think the best of the dollar exceptionalism is behind us as we move forward. And does that mean a complete rewrite? No, it just means we have to adjust the way we do portfolio diversification. And as we start to look to those things, you're seeing people adjust. The long end, I'm not as confident. You're pricing in more Fed cuts, but you're not seeing the long end come down. This is a real challenge for America and the willingness and ability to take down the deficit. It's a problem.
Who could fill the void, though, if the U.S. is no longer, or the U.S. dollar is no longer the global reserve currency?
Yeah, I think that's the balance that we have, Emery, is there is no obvious deep pool of liquid assets that we can get in and out of. So I don't know that there is one. But there have to be these adjustments on the margin because now global investors are seeing, wow, when things go bad, American assets, I'm feeling more pain than investors in America. They haven't experienced that for really 25 years. It's been a long time.
What happens if we do get a ton of trade deals in this 90-day reprieve, and then by the end of the year, there's a grand bargain with China? Does everyone just come rushing back in?
To some degree, we'll see a reprieve. But what's the famous saying? For every inch forward, it can be a simple step back, but it's going to take a long time to rebuild that confidence. And the discussions about Fed independence are a big piece of that as well. So what happens in the Supreme Court and with the oustings there from the Trump administration will be very important to restore that last pillar of reservedness, which is common law system that we all agree on.
So let's focus on the basics. If you're running a current account deficit, you need two adjustments. It's either through the rate, yields have to go up, or the FX channel, the dollar has to weaken. And a combination of both, you're leaning more on one than the other in the years to come?
So far, the currency has the most space to go. Even in your traditional interest rate models for the dollar was as overvalued as it's been since the 80s. So you have some pressure you can take out of that. But I think that mechanism in of itself, it's kind of silly to think that you can separate the currency depreciation from the capital flow. So it's going to be a combination of both. I think we're in the first phase, which is the currency. And then the global flows we'll see, and it'll come back to your point of how far do we push these tariffs?
This is clearly going to affect the premium that people want to pay for US assets.
Yeah.
How is that changing your view of the world domestically here in the United States, and particularly what you're working on now, real estate?
Yeah. It's creating this new diversification angle that you have to have. Since the sell-off here, cash and the Barclays Act have given you a similar total return performance. So it's not giving you the diversification, and it's not giving you the yield outperformance that you would have expected. So now you got to turn your portfolio construction into something else. Where can I find, if this goes very bad, a place where I can get some inflation protection? Infrastructure, real estate are places that will be there. And alongside higher rates, it's going to be very hard to build new supply. So now you're confining the supply picture for an asset where demand should go up. I think real estate, infrastructure are going to be critical pieces of the diversification angle for multi-asset investors globally.
What does trade policy mean for what you're working on right now when it comes to real estate?
Yeah, so the trade policy impact, just like everyone on Wall Street, what's our exposure? We have to figure this out. When you look at the industrial sector, that's clearly most exposed. Trade in America, about 40% of all trade or imports to America comes from Asia. I'm changing the way I'm saying that. It's not just China, it's Southeast Asia as well, 40%. That's high, but you look to the West Coast, you're at 70% of goods traded and imported come from Asia. So that's most exposed. And in the industrial sector, in our pool of assets, one of the deepest pools of private real estate assets in the world, you're seeing industrial activity, bidders show up, declining, and you're also seeing prices readjust, particularly for lease agreements that are pretty short. Now, what's going to be most insulated? It's most likely going to be multi-asset. We've had a structural housing shortage, but now higher tariffs most likely will be passed on to the house price. Best estimates, maybe 10% increases in home prices. You're talking about the most unaffordable housing market since the 80s again. So where does power restore? It restores back to owners of real estate. And multi-asset seems most insulated for me.
Let's just talk about owners of real estate and where in real estate you do and don't want to be.
Yeah.
Typically, when we talk about real estate with someone who's got exposure to real estate, they'll say it's great right now, everything's okay, and we're not marking anything to market. But at the moment, you can see some people are pulling back. Sure. Data center investment is something that comes out repeatedly, and we've seen example after example of tech firms starting to pause, starting to reconsider. Yeah. Are you seeing the same thing?
The data center investment strategy is so concentrated for many, many reasons, but predominantly because the amount of capital outlay that you need to put, there's only a select few people in the world that can do that. And that might feel good as you're the only person who can buy or invest in this, but it also means you can't sell it. For investors, you have to give liquidity, and that becomes a real challenge. Then you have your point on technical obsolescence. When you look at traditional industrial buildings, let's just make the numbers round. $100 per square foot for an industrial building on average. Great. A data center, you're over 3 times that. So where is the value? It's not in the real estate, it's in the tech inside. And I don't pretend to know how the tech inside of that will really play out. So tech obsolescence becomes a big risk. We don't own data centers in our portfolio for this reason, predominantly, but it doesn't mean there's not value in those. But being dynamic and being a tech investor, I think, has to be a critical piece of that. And I don't have that expertise on my team right now.
Final question.
Yeah.
You've seen a lot, been through a lot in your decades on Wall Street. How different is this time?
I don't think Wall Street is prepared for what is happening right now, in that the traditional portfolio allocation that everyone that comes and sits in the seat talks about is predicated on the 60-40 as the perfect portfolio. Now, that doesn't mean you rewrite and throw out the script. I'm not saying that. But the reason you bought things has to be different. And it's mostly, I think, in that 40 portfolio where the bonds that you're buying, they're not giving you diversification in income as they have for the last 25 years. It's just not happening. So you have to buy them more deliberately for this. And I think that diversification piece is changing. It's going to involve a bigger pool of assets.
I'm pleased you're pondering this because I don't think enough people are. I think for a long, long time, decades in fact, there has just been this relentless structural bid for US assets. And it's within the post-war system, and we're having a real rethink of that right now. In fact, the administration is actively challenging it. Increasingly, you're having those conversations with clients. They're receptive to it, that we are seeing this fundamental, profound shift potentially in our future.
The best chart to pull up is just the correlation stocks and bonds over time. You go back prior to the late 90s, stocks and bonds were positively correlated. So what happened? What changed? I think globalization changed, confidence in Fed independence increased, and now both of those things are being challenged. So you have to think things can change and reverse. And now it's helpful that people like me can sit here and say, it's been 3 years and it's positive correlation again, like time starts to show it. I think This is the biggest challenge that, again, everyone on Wall Street is trying to figure out. If it's not that 60-40, what is the optimal portfolio? And it's an adjustment, I think, that's going to happen globally and also in these diversifiers.
Tom, appreciate your time. As always, thoughtful stuff. Tom Kennedy of JP Morgan. We're all on this journey together, navigating some big shifts potentially, and I stress potentially. Equity futures right now in the S&P positive by 0.7% with an update on stories elsewhere. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. The U.S. has set new duties as high as 3,500% on solar imports from Vietnam, Cambodia, Thailand, and Malaysia after a year-long investigation. That investigation found solar manufacturers were unfairly benefiting from government subsidies, selling their products to the U.S. at rates below the cost of production. A check on Verizon shares, those falling in the pre-market nearly 5%. It reported a larger than expected decline in mobile phone subscribers in the first quarter. The largest U.S. wireless provider also reported quarterly earnings that beat analyst estimates and said it is on course to meet its yearly goals. Amazon's web services business is pausing some data center leases. According to Wells Fargo, it's unclear if the pause is of concern or part of the flow of hyperscaler activity. AWS's VP of Global Data Centers wrote on LinkedIn that it has not changed its expansion plans. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Up next on the program, the morning calls, plus Tom Naran of RBC with Tesla earnings on deck. Those numbers dropping later on this afternoon. From New York, this is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The opening bell about 1 hour and 14 minutes away. Going into that, your price action looks like this. Equity futures positive by 0.8% on the Nasdaq 100, up by 0.84. That's the price action. Let's get to your morning calls. First up, Goldman downgrading Macy's to neutral, citing macro uncertainty and cyclicality risk. That stock is negative by 0.5%. Your second call from Barclays, downgrading Texas Instruments to underweight, saying tariffs are hitting the company from all angles. That name is down by 1.3%. And finally, Bank of America lowering its price target on Nvidia to 150, pointing to export restrictions on the company's H20 chips. That stock is doing better. It's up by more than 1%. Let's stick with the Max 7. Tesla reporting earnings after the closing bell. Questions looming about the impact of tariffs. Tom Naran of RBC writing, we expect Tesla to price tariff impacts to consumers, and as a result, we expect volumes would come down further in a permanent tariff scenario. Tom joins us now for more. Tom, welcome to the program, sir. Welcome back. Thanks for making time for us, as always. Those numbers drop later on this afternoon. Just give us a preview of what you're expecting and looking for.
Yeah, like is always the case with Tesla, folks
we'll look initially at the quarterly numbers and then wait for the earnings call and to see what the CEO actually has to say. I think it's going to be no difference today. Folks will look and see what the automotive gross profit margin is. I think consensus is like a 12.8%, which is pretty de-risked if you look at how it's been recently. We already have the delivery number. We know what they were. We know why what happened there. I think because of the de-risk situation, folks will want to hear about the commentary on the conference call and the Q&A, specifically about what's going on with the affordable car, right? The affordable model, we think, is one of the big reasons why the delivery number was low. Also, the production cut that they did for the Model Y refresh. Also, commentary on tariffs. Big topic, obviously. And the robotaxi launch in Austin in June. So we think it's going to be more about the commentary there as opposed to the specific numbers hitting in the quarter.
Tom, the elephant in the room seems to be the future of Elon Musk. Do you expect it to come up on the call, and what kind of commitment do you think Elon Musk can provide?
Yeah, I probably will come up on the call. I don't know what he will say. The sense is that what they have been saying in the past, the entire management team, this is a robust management team. They're executing on a number of things. We just talked about a few of them. So I suspect the Wall Street community may not be as focused, perhaps, as the retail investor community may be, or the press on this topic. Focus will really be on strategy and what the company is planning on doing for the year, and the response to the tariff question, I would say, more so than some of these other topics.
Tom, though, when it comes to the Tesla brand, can you untangle Elon Musk to that brand?
Yeah, it's a great question. It has been a big benefit for years, right? Tesla doesn't really have to advertise as much as, let's say, a Mercedes does, which is like, what, a couple $1,000 per car, because it has this halo effect on the brand. Maybe that, maybe that's changed somewhat. But what I would just comment here is we're at the point where this is no longer a startup, right? It's half of the entire U.S. EV market, virtually, on sales per year. If you're in the market for an EV, that's half the market. There's a reason why people like the product. I've said this before on your guys' show, like, people are going to do what's best for their families. If they're going to buy the best, what they consider the most established EV brand or not, that ultimately will drive the narrative. If this was maybe 10 years ago or 5 years ago, maybe that's a different story. The brand now is the product, I would argue, more so than anything else.
So is it fair to say you don't agree with Dan Ives, and I'm sure you've seen his comments, that Tesla is facing a, quote, code red moment? I like Dan Ives a lot, actually. But I would just say, look, if you're looking at Tesla, okay, as an investor, as we do, this is a tectonic type company, right? Well, I look at it in decades, not months. Certainly right now, there's so many headwinds, right? Tariffs is not going to be, it might not be that pleasant. Now, we'll see how that plays out, right? Maybe that's resolved in a few months. We don't know. But look, 10% of my valuation is cars. A lot of the headwinds we're facing now has to do with cars, including tariffs, affordable car, whatever political things are going on. But the reality is robotaxi, autonomy, FSD, that drives like 80% or something of my valuation. And these are all things that will play out in time. I'm more of a believer in autonomy as a big picture item. And then I go top down and I say, well, Tesla has a great product with FSD. And I think they'll have a portion of this incredible opportunity for the mobility industry. They won't be the only ones benefiting. So I'm looking at it kind of like a top-down approach. And I think, like, fine, yeah, sure, near term, there's a lot of issues here, obviously on the car business. But let's take a step back and appreciate what is about to happen to this industry when it comes to autonomy. I think it will increase the share of wallet that all of us pay for mobility by multiples. It's not box with wheels anymore, right? And now it's something that can change our lives. And they're in a unique position to capitalize on. Let's see if they will.
There is a lot of open questions. I will definitely admit to that.
Hey, Tom, the question I always get from Bloomberg subscribers, whenever a Tesla bull comes on the program, they want to know, what would it take to make you bearish? Tom, what would change your mind on the name?
Yeah, I mean, we just talked about it, autonomy, right? You know, a big bullish thing is unsupervised FSD. If they get that, it's the mousetrap, right? Nobody else has something as cheap as them, and they get to dominate this market that could be triples or quadruples of what the auto industry is. Now, what happens if unsupervised FSD does not happen? What if there are roadblocks to achieving this autonomy world? What if there are other players that can do level 2+ as well as Tesla does? Now they lose that comparative advantage. So I think if there's an obstacle to them achieving their autonomy goals, that would be a bigger issue.
Tom, just quickly to look out beyond Tesla and look beyond the US car market, the US auto market, and focus on Europe just for a moment. I think Europe's going to be really interesting in the months and quarters to come. We talked a number of times together about how much capacity needed to be cut on the continent. And Tom, what we're about to see potentially, and neither of us know what's going to happen with tariffs in the next several months, the next several years, but let's just say they stay where they are. Tariffs go up in the United States, the walls go up, and you face this situation where China just aggressively pursues the US consumer, starts buying up plants and capacity across the continent, Tom. What's the prospect for that happening, and how under threat do you think some of the European players might be with that in mind?
Yeah, that's a story that you're painted, that's the worst case scenario. Certainly you would see consolidation happen, you would see brands going away, you would see the SAR level there drop by millions. Now, I do just want to note, remember, Europe is different than other countries where you do have national champions. You have governments invested into keeping these companies alive. So while, production may come down, deliveries from these companies may come down, I think the governments will do what they can to keep the national champions alive. They'll have to do JVs with the Chinese companies and produce in Europe. They'll have to increase production in the US, like we saw what BMW announced recently, that they're going to increase production in Spartanburg. So there's things they can do. Maybe the European companies won't be as robust as they are today in terms of how much they're producing. They'll have to partner with others. They'll have to shift. But I think some of them will definitely survive.
Hey, Tom, appreciate your view. Tom Naran there of RBC. Looking ahead to numbers from Tesla a little bit later on this afternoon. That name in the pre-market is higher by 0.8%. Up next on this program, we'll catch up with the former New York Fed President Bill Dudley, get his reaction to the pressure building on Fed Chair Jay Powell and the erosion of at least the perceived independence of the central bank, and then get a reaction on the bond market moves of the past 24 hours. We'll catch up with Michael Kushner of Morgan Stanley from New York. This is Bloomberg.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening about 60 minutes away. Equity futures at the moment positive by 0.8% on the S&P, on the Nasdaq up by 0.9%. With that opening bout just around the corner, let's get your morning movers with Danny Berger. Hey, Danny.
Hey, John. In the thick of the earnings season, 3M reporting results, a solid beat on this quarter and no change to their guidance for next. That on its own has allowed shares to move up 7.4%, though they did issue a caveat to that. They said that they could see an earnings hit of somewhere between 20 to 40 cents a share. That initially sent shares lower, but again, perhaps the positive results and the fact that they didn't necessarily bake that into their baseline outlook is helping us gain from here. We also heard from a lot of the big defense contractors this morning. Lockheed Martin, solid set of earnings, but different for Northrop Grumman. Those shares down nearly 9%. This is because of a cost overrun when it comes to their new stealth bombers. It's something that they've been putting a lot of money in, trying to get it up to the market sooner, but because of those costs, a big miss on their part, down nearly 9%. Finally, wrapping things up with GE Aerospace, another solid set of results. They also didn't change their outlook, and they said that that includes the tariff impact, and it assumes that they're not going to see any big changes to tariffs. I wanted to bring this one up, though. Shares are up 4.6% because Larry Culp, the CEO there, speaking in an interview with Bloomberg shortly after the earnings, saying that he met with President Donald Trump, he met with this administration and talked about the benefits of a tariff-free regime for this industry, saying that it could help the industry have a trade surplus. He said he was optimistic that Trump was receptive to that message. John.
Danny, thank you. Appreciate the update. That stock is up in the pre-market. Got a busy day of Fed speak coming up as President Trump continues his attack on Fed Chair Jay Powell. Michael McKee, our economics and policy correspondent, joins us now for more. Good morning, Mike.
Good morning, John. Ordinarily, this would be the kind of week where everybody would be paying absolute attention to the Fed because we've got a Fed meeting coming up in 2 weeks. But it's not clear that there's going to be a lot of breakthrough from Fed speeches to the overall investing community. We've got a lot, as you mentioned there today, and a lot this week. Not all of them are going to matter. We've got a couple of them who are off topic. They're doing sort of Fed Listens events, trying to figure out what people are thinking of the Fed these days. But there's certainly a number on policy. The issue is, are they going to be telling us something about what they're going to do, or are they going to get asked a lot of questions about Jay Powell and his future? Because that seems to be all anybody is concerned about at this moment. We heard from Austin Goolsbee on Sunday and Monday, and he said the same thing basically both days, that Fed independence remains the most important thing, that you can't have anybody doing a good job unless they are able to do the job as they see it. Now, none of this, as I said, has made an impression on investors in terms of the next Fed meeting. We are going in with a probability of 0 rate cuts. I think there's a 10 basis point chance of a rate move from the Fed. But what we will see is this weekend, the Fed blackout begins, and that might be what everybody is really looking forward to.
If the Fed meeting was tomorrow, Mike McKee, and the news conference was at 2:30 Eastern time, I think we all know what the questions for the Fed chair would be. We had a movie. We saw the rerun of this just maybe a few months ago. I think it was before Christmas, where the president was asked directly about whether, the chairman rather, was asked directly about whether he could be fired, Mike. Do you think his stance on that, his response to that question might change?
No, he's absolutely certain. He made that clear last week. And when you talk to Fed people, they note that the Fed is structured differently from other agencies and that they think they have a very good legal case that the president cannot fire members of the Board of Governors, and they're willing to take it to court to find out.
Mike McKee, thank you, sir, for the update. Here's the take from the former New York Fed President Bill Dudley writing this. Trump's pressure on the Fed is counterproductive. Not only does it increase the motivation for the Fed to wait, but it also makes households and businesses more concerned about the inflation consequences should the Fed's independence come to an end. Bill joins us now for more. Bill, welcome to the program, sir, and good morning. I want to pick up on the first part of that second line. Not only does it increase the motivation for the Fed to wait. Can you build on that a bit, Bill? Motivate to wait. Where does that motivation come from?
Well, the Fed's credibility is really important, and if the Fed is seen as sort of caving to political pressure, that impairs the Fed's credibility. And if the Fed's credibility is impaired, that's going to lead to higher inflation expectations. So, this is why the Trump pressure on the Fed is counterproductive. It's basically putting markets on edge, and we can basically see that just in the last 24 hours. Gold prices up, dollar weaker, bond yields up, at a time that people are expecting rate cuts. I mean, the market still expects the Fed to cut interest rates this year by 75 to 100 basis points. So we see the market response is they don't like the fact that there's this uncertainty about the Fed's independence. From President Trump's perspective, this is really counterproductive.
Bill, just to build on that, another way of saying that would be that when the independence of the Fed is threatened, the threshold to move is higher. They dig in. Is that a fair way of putting it?
I don't think it's so much that they dig in to be, stubborn. I think the fact is, though, that if the Fed's independence is under threat, if they move, then people wonder what's the motivation. Is the Fed moving because it's the right thing to do, or is the Fed moving because they're under pressure? And to the extent that people think that the Fed's moving because they're under pressure, that undermines the credibility of the Fed. And so the Fed has to take that on board in terms of their thinking.
So basically what you're saying is they cannot move for a while now, given Trump's ire, because it'll look like they would be placating this White House?
Well, it depends on the economic news. Obviously, if the unemployment rate goes up significantly, then the Fed's going to cut rates because there's not going to be any question about whether it was in response to the President Trump's pressure. But if there is a question about why the Fed is moving, then the Fed has to take that on board in terms of their decision making.
What do you expect the Fed to do this year? Do you think they're going to have a bias towards which part of their mandate, inflation or growth concerns in the labor market?
Well, I think in the short term, they're going to have to be patient because obviously there's a lot of uncertainty about where we're going to actually land on trade policies and tariffs. Number two, the tariffs, to the extent that they do go up significantly, which seems likely, is going to flow into prices. And we're going to see some higher inflation data. And I think the Fed's worried about the fact that, missing the inflation mandate for the 5th year in a row could cause inflation expectations to become unanchored. And if that were to happen, that'd be terrible. One reason why things worked out so well over the last few years is that inflation expectations did stay well anchored. So the Fed didn't have to push the unemployment rate up to get inflation back down relatively close to their target. If inflation expectations become unanchored, the job becomes much more difficult. So the Fed has to be very careful not to act too prematurely, because if inflation expectations go up, their job becomes much more difficult.
Bill, 6 years ago, you wrote a piece for Bloomberg Opinion. I'm sure you remember it well because it was controversial at the time. You said the Federal Reserve shouldn't enable President Donald Trump, that the central bank should refuse to play along with an economic disaster in the making. Does that apply this time around?
Well, the Fed shouldn't take politics into consideration in terms of their monetary policy decisions. They should do what they think is appropriate to achieve their dual mandate of stable employment, full employment, and price stability. And I think that's what they're going to do this time. I mean, I don't think the Fed's political at all, and I think that's completely appropriate. But the Fed has to be aware of the confidence that people have in the Fed and the Fed's ability to be independent. And to the extent that confidence is eroded, that weighs on the effectiveness of monetary policy.
Bill, just to bring that up again, do you not stand by that piece anymore that you wrote way back in 2019?
I stand by it in the sense that the Fed has to do what they think is appropriate to achieve their dual mandate objectives. And if the administration is doing things that are counterproductive to that, then the Fed needs to take that on board. But the Fed shouldn't be acting in a political manner. The Fed needs to be completely independent of politics, and I think they are.
Do you think the Fed is completely independent of politics, given the fact that the Fed chair has been outspoken about the tariff regime?
I think the Fed chairman just talking what everyone can see. I mean, higher tariffs are bad for prices. They're going to drive up the inflation in the short term. To not say that would not be credible from the Fed's perspective.
Bill, appreciate your time, sir. As always, Bill Dudley there, the former New York Fed president and, of course, a columnist for Bloomberg Opinion. If you are just joining us, this bond market has settled down. Bond yields on a 30-year down by 2 or 3 basis points, the 10-year down by 2, and a bit of dollar strength out there. Certainly yesterday it was nothing like this. A lot of dollar weakness and the bond market selling off, yields pushing higher. To talk about that, Michael Kushmer of Morgan Stanley joins us now for more. Michael, good morning. Good to see you. Are we getting to the point where you start to think about buying this Treasury market, or is it still hands off, wait and see?
Well, if you step back a moment and think longer term, 10-year bond yields haven't been much different for well over a year. They bounce around a lot, but from 4.50 to slightly below 4, which we saw just right after Liberation Day, they bounce right back over 4. They get to 4.50 and they can't really sustain levels above that. The curve is a lot steeper than it used to be with 2-year yields where they are, where 10-year yields are. You would argue around 4.50 is a level which, given all the uncertainty, it is a safe haven in that sense, but don't expect yields to come crashing down.
Hasn't behaved like a safe haven, and it's the behavior of it that spooks some people. You have down days in equities like the one we saw yesterday, and the bond market doesn't receive a bid. In fact, you see the opposite. You see the bond market sell off, yields climb on a 10-year and a 30-year. A number of weeks ago, you could make a very coherent argument that I think most people would accept, that we were seeing trades unwind, things blow up, that push people out of treasuries. Can you still make that argument now we're moving out of that phase of the sell-off?
Well, I think it comes down to valuation, right? So think of bonds as a safe haven as insurance. And insurance can be expensive or it can be fairly valued or cheap. And bond yields get below to 4% or lower. They are not much of an insurance premium. You're just paying a lot for that insurance premium, and maybe it doesn't work that well unless certain things happen. But the very nature of the shock we're talking about in terms of a stagflationary shock and rising inflation undermines the ability of bonds to perform well. And similar to 2022, we had worries about recession and bond yields were not going up, with real yields were rising, as they've done lately as well. Risk premium rising on everything, including bonds. So it's difficult for them at recent valuation levels to perform well when equities do badly.
So what's the true safe haven right now?
Cash, and the market clearly thinks gold, things that were independent of things that do well with inflation. Policy rates are still high, 4.5% or so. That's still reasonably high by historical standards. So you get a reasonable yield on cash for now relative to other assets, and gold keeps doing well because it's the global alternative to the U.S. dollar.
When we see the dollar go down, we've seen the euro just on an absolute tear, which Jonathan has talked about a lot. At the start of the year, everyone was talking about parity when it comes to euro dollar. At the same time, we also see a lot of flows into things like sovereign debt markets in Europe. Do you think that's a place that people want to continue to trade?
We've thought that Europe, in many ways, the flip side of the U.S., without retaliation, which Europe hasn't really done, that German government bonds in particular can be a safe haven because policy can respond positively to the negative shock of tariffs being imposed on exports from Europe. So the central bank can ease rates aggressively. The ECB could go back to 0 interest rates. Inflation is coming down, not going up. Fiscal policy committees, all these things which can support the economy, support the performance of the Eurozone, and particularly the currency as well. And we know European investors have been very overweight at global investors in U.S. dollar assets, moving back to the euro. Euro goes up, ECB cuts more, and you cushion the blow.
How aggressive do you think the rest of the world will be with regards to rate cuts?
I think they could be very aggressive, depending on how it's going. Inflation is not really an issue in most countries, and we've seen that in Canada in particular, very linked to the U.S. economy, aggressively cutting interest rates in the past 6 to 12 months relative to the U.S., not just in anticipation of tariffs, but the fact that things were deteriorating at a faster pace than they were in the U.S.
You mentioned Europe. Let's talk about the ECB a little bit more. They reduced interest rates last week. That seemed to annoy the President of the United States at the time. I think it's continued to annoy him. We've said on this program, the biggest threat potentially to European price stability is actually Chinese exports. You just said that maybe they could go back to 0. Do you think that's possible?
I don't think it's possible, but it's possible in the sense it could theoretically happen, logically happen.
Of course.
But in practice, I don't think
That's what I'm trying to gauge, though. How deep do you think the rate-cutting cycle might be elsewhere? We're seeing a ton of dollar weakness starting to emerge, which certainly gives them the space to do that. And the disinflationary impact of Chinese overcapacity on the rest of the world with the walls up in the United States certainly gives them even more space to do that. So I'm trying to figure this out. We're talking about 150 basis points? We're talking about more?
We're getting closer to 2. We're one more rate cut. I think we're at 2. So I think 1.5, another 50, 75 basis points is certainly possible, depending on how this whole tariff situation unfolds. Because again, the hard data hasn't really deteriorated anywhere. Sentiment data has deteriorated significantly. Some forward-looking orders data is weaker, but actual economic growth has not really been impacted yet.
But the soft data, we've seen it come in weak.
Absolutely, absolutely. Whether that translates into actual weaker data, we'll have to wait and see. And a lot of that is confidence. Consumers change behavior. We saw that in Europe in 22, 23 because of the rise in energy prices. Consumer spending collapsed in Europe. That's the danger for the U.S., that we have an inflation shock through tariffs in the next 12 months, and U.S. consumer spending drops back significantly.
What would be the tell for you that the soft data has impacted the hard data?
It's the labor market. If the labor market stays reasonably firm, household spending will slow down. Not saying it won't slow down, but it won't get to precipitous slowdown such that you actually worry about negative growth. So a slowdown's okay. We get closer to zero growth. But if unemployment goes up, households really pull in their spending, that could be much more detrimental.
Michael, it's good to see you. Thanks for dropping by. Michael Cushman there of Morgan Stanley. The good news for you this morning, the bond market's settled down, stable, yields lower across the long end of the curve. We're down 2 basis points on a 10-year, similar move on a 30-year bond. Let's give you an update on moves elsewhere and your top stories in your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Pope Francis's funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. A viewing of his body will begin this Wednesday in St. Peter's Basilica. President Donald Trump said he and the First Lady would attend the funeral, embarking on the first foreign trip of his second term to honor the late spiritual leader. Elsewhere, President Trump says that U.S. Defense Secretary Pete Hegseth is doing a great job despite what he called attacks from disgruntled employees. Hegseth facing staff churn, a leak investigation, and a report that he shared sensitive military plans in another unsecured group chat. A former Pentagon spokesman says that the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration. Harvard University suing the Trump administration for freezing billions of federal funding. Harvard President Alan Garber says that the freeze happened after it refused to allow illegal demands to make changes to governance, discipline, and hiring practices, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead and look ahead to earnings from Tesla, from New York. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures positive here by 0.9%. The opening balance about 41 minutes away, and the Nasdaq higher by 1 full percentage point. Your trading diary looks a little something like this. A slew of Fed speak today, including Jefferson, Harker, and Kashkari, plus results from Tesla after the closing bout. Tomorrow, Boeing earnings and PMI data. On Thursday, durable goods and another round of jobless claims, plus Alphabet results. On Friday, get another reading, UMich sentiment, the final read going into the weekend. Joining us now is Bloomberg's Ed Ludlow with a preview of Tesla's results. Ed, welcome back to the program, buddy. Share with us what you're focused on later on this afternoon.
Yeah, I think most people are just bracing on who shows up, right? The version of Elon Musk that shows up to the earnings call. And it's not so much just that he's disconnected and focused on Doge and his work with the administration, but it's that, you know, he's critically important to the company. And I think most people just want to hear something, although, you know, that's the joy of being able to track the average of analyst estimates, right? Like profit expectations have really come down in the last month or so. And we know that the first 3 months of this year was tough, but there is a lot of question to ask and a lot to quantify on how Tesla navigates this trade environment, because while it's insulated compared to other US automakers, it still has Mexico exposure, right? Simple things like the glass on the windshield and other integrated circuits from China that basic questions need to be asked about.
Ed, Dan Ives put out a note and said Elon Musk is Tesla and Tesla is Elon Musk. They're synonymous. But what happens when he does, in fact, leave his government job, leaves Doge? Is it a fact that he goes back to Tesla and focuses on cars?
It's the perfect time of year to go trawling through 10Ks. Go to page 20 on Tesla's 10K that published in January and read the how important is Elon Musk this company graph, and it just gets longer every year. So they list all the other companies that he's involved in and say we are highly dependent on Elon Musk, but he also has obligations at XAI, Boring Company, and now the Department of Government Efficiency. What I'm hearing from investors is that there's this kind of split camp, right? So the Dan Ives note is very clear. Go back to Tesla, focus on Tesla. But there are many out there that think actually what he's more interested in is XAI. You know, I'm hearing increasingly that he's very focused on XAI being competitive with OpenAI and Sam Altman. He's more regularly attending investor calls and, you know, trying to finance the growth of that private company, having taken it through the sort of interesting financial mechanism merger with X. So what would happen there? You know, but again, all we can do is play what's in front of us right now, and that's how does he discuss his role with Tesla on this evening's earnings call?
Ed, what changed? Back in November, this stock surged, and we had people coming on the program saying that there was this big halo effect from being close to the Trump administration. What changed?
Yeah, the Trump bump. I was looking at the chart, like November 15th, for example, was this day where we thought, okay, this is great for Tesla. You know, Musk has made efforts to put Tesla in the spotlight, right? There was the pictures of the president with a Model S and then the president pledging that he would buy a Tesla. But there's also the reporting that Trump has differences with that cabinet, particularly on tariffs, right? And he has made the appeal, it is reported, to Trump to rethink tariffs. I think that people thought he would be more influential on policy, even though he has this sort of clearly demarcated remit with Doge. And now there are doubts about that, while at the same time, you know, Musk is less focused on the running of Tesla. That said, John, as you know very well, like we say this every quarter, there are very capable people at Tesla in very important jobs running the place while he's doing whatever he's doing. It's not as if it's a rudderless company, but again, that key man risk is just so apparent.
Ed, looking forward to the coverage later on this morning, 11 a.m. Eastern Time for Bloomberg Technology, weekdays with Ed Ludlow and Caroline Hyde. Look out for that a little bit later, and then earnings from Tesla coming after the close. There's been a big shift in what his presence with this administration means for this stock, certainly comparing now to where we were back in November.
Everyone thought that the first buddy was going to have all this influence on the president, and as well as potentially it would insulate maybe Tesla. But Tesla's not insulated when it comes to things like tariffs. To Ed's point, yes, there's a lot of manufacturing in America, but even things like Mexico, they need to be worried about. And then this idea that you do have Democratic senators and congressmen and women coming out and saying, we're going to ditch our Tesla because we don't like what Elon Musk is doing at things at Doge, which is why Dan Ives, this long-time bull, is saying it is a code red moment. They want to get the branding of Elon Musk away from the Oval Office and back to Tesla.
Just a quick final word on trade. The clock is still ticking on this 90-day pause, this 90-day negotiation. Periodically, we hear some soothing words about India, then Japan, Japan, then India. Are you seeing any reason to be confident that we can secure some of these trade deals before that window closes?
Not a full deal. I think what you have to read the tea leaves out of J.D. Vance's meeting in India with the prime minister there is that they talked about a possible roadmap for a deal. And India has talked about the fact that they think they can ink a deal by the fall. Well, the fall's obviously not in 90 days. 90 days is basically just after July 4th. But what if they can get a roadmap? And then that would mean that they stay at the 10% base level, not the 20, 30, 60% that some of these countries are facing. So if everyone can come out with a roadmap, that might be enough to keep the reprieve.
The clock is ticking. This is what Torsten Slok of Apollo had to say yesterday. If current policies do not change, then the probability of a US recession in 2025 is 90%. 90%. Let's see if those current policies do change. In the equity market at the moment on the S&P 500, we bounced back by 1% on the S&P, going into that opening bout just around the corner. A welcome move in the bond market. Yields just about stable on a 10-year and a 30-year. Yields are lower by 3 basis points. On 10s, on 30s, we're down 3 or 4. And in foreign exchange, a big turnaround in euro-dollar. Euro-dollar yesterday with a big move in the euro's favor. The dollar hitting a new low for 2025. Euro-dollar down by 0.4% at 114.72. Coming up tomorrow, we'll catch up with Julian Emanuel of Evercore, David Leibovitz of JP Morgan, Scott Kroner of Citi, and Torsten Slok himself of Apollo from New York City. This is Bloomberg.
Welcome to a special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Novak Djokovic is a 3-time champion in the Spanish capital, and the 24-time major winner will be looking for his 100th career title this week. On the women's side, the Queen of Clay, Iga Swiatek, will be hoping to successfully defend the title she won a year ago. And don't forget, you can watch all the action live on Tennis Channel.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings stick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
All right, happy Earth Day. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, an eerie calm settles over Wall Street this morning as investors take stock of the Sell America trade.
This month is shaping up to be one of the worst Aprils since the Great Depression for the Dow Jones Industrial Average.
And earnings kick into high gear. Corporate America offering more clues on the real cost of that tariff uncertainty. All that and more coming up, but let's take a look under the hood and talk about Tesla. Reporting this afternoon as the company tries to navigate brand damage from Elon Musk's work in the White House, but shares currently higher by about 1.4%. We'll see if that lasts.
All right, Northrop Grumman has cut its earnings outlook for the year. Manufacturing costs rose due to a change in the production process, and those shares have been literally decimated today.
I am also looking here at Verizon because they had lost more customers than expected last quarter due to heavy competition in the wireless space. Verizon down 5% pre-market, Katie.
And breaking just now, the IMF sharply lowered its global growth forecast for this year as Trump's tariffs spark a global trade war. Let's discuss now with Bloomberg Chief International Economics and Policy Correspondent Mike McKee. Mike, the number here, the big headline, IMF cuts 2025 global GDP growth forecast to 2.8% from 3.3%. And I think we can guess it has something to do with trade.
It has a lot to do with trade. The IMF saying that it is so difficult to put together a forecast. They had to do 3 or 4 of them. They had to start all over again when Donald Trump announced tariffs. And this is what they call their reference forecast, the one they're kind of going to work off. But they say lots of things are still possible. But as you mentioned, a big drop in global GDP is forecast for this year from the IMF. The growth slowdown will create disinflationary pressures. We'll get a little bit of inflation, but not as much because the economy of the globe is going to slow down, so only 0.1% up. But country by country, the outlook is grim, especially for the United States. The IMF is now forecasting a growth rate of 1.5% for this year. That's down almost a full percentage point from where they thought we'd be just a couple of months ago in January. And what also sticks out is China, 3.2%. That would be the lowest in decades for the Chinese. They're going to be, of course, a big part of the Trump tariffs. For inflation and unemployment, it's the same story. Inflation higher in countries around the world, unemployment higher in countries around the world. And so it's going to be difficult to see much good news out of the IMF. And they do, as I mentioned, fall back on blaming Donald Trump. The IMF chief economist saying, unlike in the previous century, remember Trump was always talking about the McKinley era and the era of tariffs in the 1920s, the global economy is now characterized by a high degree of economic and financial integration with supply chains and financial flows crisscrossing the world, whose potential unwinding could constitute a major source of economic upheaval. And that's what the numbers seem to show.
Mike, I want to hone in on the U.S. in particular. Not only was the forecast for growth cut, the forecast for U.S. inflation was roughly 1 percentage point higher to 3%. Amid the many challenges the Federal Reserve has to face right now, particularly political challenges, this is a picture consistent with stagflation, isn't it?
It is. The economy slowing and inflation rising is exactly what the Fed is afraid of because they're caught. They can't raise rates to stamp out inflation without helping slow the economy and vice versa. So this is going to be a tough situation for them. Now, the IMF does think that inflation won't go up as much as it might otherwise under tariffs because they're going to slow the economy so much. And so the Fed, Jay Powell talking about it last week, might wait a little longer to see if some of the inflation we get starts to fade as the economy does. But they're still going to have to make a tough choice at some point.
All right, Mike McKee, thanks very much for that. Michael McKee talking to us about the IMF cutting its growth forecasts. Right now, I want to focus in on Tesla because after the bell, it will report earnings. It has faced growing backlash, obviously, from Elon Musk's ties to the White House. Shares are down 43% this year. Bloomberg Technologies' Caroline Hyde is here to explain what investors are looking to see on the call.
Well, on the call, some hype, some injection of enthusiasm coming from one Elon Musk, because that's what he usually manages to do, strip away the fundamentals, get more excited about the future, because this company is trading at 78 times its current price. So prices at currently future earnings 78 times that. This is a company that trades on hope for robo-taxis. Will we start to see the proof in the pudding in Austin come June? What about the self-driving? Also about a cheaper Model Y as well. We're expecting that in the first half of the year. The reports have been from Reuters and the like that a cheaper version of Model Y is being pushed back by another 3 months. So how they could take on the BYDs, the cheaper competition over in China. All of this needs to be given more specifics because right now we're just trading on bad politicization, an issue of European and US sales falling. We saw ugly vehicle sales in the first quarter, an ugly quarter for the stock. It had its third worst quarter since its IPO in 2010.
Caroline, I want to shift gears. I want to talk about Amazon as well.
Yeah.
The reason being, you have another report now. Wells Fargo saying that Amazon is pausing some data center leases. Everyone might remember when TD Cowen said the same thing about Microsoft. Twice, and it was a big dispute on whether that was happening or not.
What actually is a lease?
What is a lease? What's a promise if you don't write it down on paper? I mean, Amazon, how big of a move is it, and how frightening is it to investors to see these types of CapEx expenditures paused?
It was frightening for European power investors. You saw Schneider Electric, some of those electricity providers to the future of AI, take a bit of a knock on the fact that Wells Fargo is putting out. Look, all of this is so couched in murkiness. Overall itself, Wells Fargo is saying it's hard and it's not clear as to whether AWS is slowing some leases in the area of concern or whether these are just natural ebbs and flows. We're trying to understand how much they're pulling back from leases in Europe, how much they're pulling back internationally rather than trying to double down here in the United States. It is notable on LinkedIn, AWS, well, one of the executives, Kevin Miller, came out saying, can I bring you some clarity here? We are not changing our overall demand outlook for artificial intelligence, for generative AI, and we're not pulling back overall in our offering of data centers. So he's trying to make clear that this is just a natural course of business, that they're doing their due diligence, they're trying to rein in costs, perhaps, but all of this just adds to that anxiety that you've got Microsoft and AWS just being more picky. Why not be going pedal to the metal at the moment in terms of your overall allocation of capital expenditure? Why not be getting lease after lease if we're still talking about insatiable demand for generative AI more broadly?
Some of the big questions as we head really into the heart of earnings season. Caroline Hyde Great to see you. You can catch her on BTech at 11 a.m. But we have some breaking news right now, and that is Boeing has agreed to sell its digital aviation solutions assets for $10 billion to Thoma Bravo. Bloomberg's Benedict Campbell joins us now. And Benny, we know that Bloomberg had reported that they were looking at this, that they were getting closer to a deal. You can see Boeing shares up about 3% right now. What do we know about this deal so far?
Hi, so we've known for a while that this is something that Boeing is looking at selling. This is a very profitable business. It's one they bought for a fraction of that price about a couple of years ago. And as they were looking at their portfolio and looking at what they might want to keep, what they might want to sell, this was always top of the list. And now it's confirmed. We had the scoop yesterday. Shout out to the team that this would happen, and now it's been confirmed by Boeing. The company reports earnings tomorrow, so we'll get a lot more details on that. But this is somewhat expected, but it's a good price they're getting, and it gives them a lot more financial firepower, which they'll surely need given the difficult market they're operating in.
I got to ask about Northrop Grumman. The company's been decimated, really, reduced by a tenth after it came out with an earnings miss. What's the story there?
It's a very Northrop-specific story. Generally, sort of defense contractors, the primes, have been doing pretty well in this climate. There's a sense out there that, given everything, that there's still money to be spent on defense assets. But Northrop, as you said, down almost 10% in pre-market at one point. The story is that their B-21, that's their sort of advanced long-range stealth bomber, that's going to cost them more to build. They've been taking a bunch of charges on that in the past, but they've added some more on that as a result. They've reduced their forecast for the year. So a fairly specific program story there for Northrop that doesn't really speak to the broader industry, but there's a lot of insecurity out there. We've heard it from a couple of other companies. Lockheed reported today, RTX reported today, and they've all said, the tariffs and the general climate certainly aren't helping in terms of the outlook. So you see some insecurity in that industry.
Yeah, it's a good point that Northrop is a standout in a bad way when it comes to the rest of the industry. Bloomberg's Benedict Campbell, great to see you. Meanwhile, check on these broader markets right now. You're seeing some green on the screen when it comes to the S&P 500, higher by about 1% in the pre-market. We know we had a pretty rough day yesterday for really all American assets. You see a little bit of a bid coming back right now into the bond market, into our currency market, but that gold bid continues. Now, coming up, markets discovering, like I said, that the real Trump trade perhaps is to sell America. We'll take a look at today's big take next. This is Open Interest.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We're sort of in this growth scare phase, which is similar to the 2010, 2011, 2015, 16, and 2018 drawdowns, where there was real fear of a recession or a big systemic crisis, but it did end up happening, right? It was a near miss. That's what we're pricing in right now. So the market is clinging to some hope that we can avoid a big crisis and that we can avoid a recession.
That was Lori Calvasina, RBC head of U.S. equity strategy, speaking this morning on Bloomberg. Now, there's so many superlatives we could give you an answer to that question. It's the worst start to a presidential term for the S&P since at least 1928, the worst April for the Dow Jones Industrial Average since the Great Depression. But I think this one speaks the biggest or the loudest. This is U.S. stocks versus the rest of the world, ex-U.S., and it's the worst underperformance for U.S. stocks as measured by the S&P in 32 years. So the question is, will international investors continue to rotate out of U.S. stocks into the rest of the world? Let's put that question to Michael Ball. He joins us here on set. He covers stocks for us at Bloomberg News. So Michael, what do you think about the incredible underperformance of U.S. stocks, and will it continue, the sell America trade?
I think so. I think until we get certainty on policy, which doesn't seem to be coming anytime soon. I'm not just talking about trade policy. I'm talking about the overall picture of policy, which could be taxes, which could be immigration, which could be other things like regulation, all of which are still TBD. We're not going to be able to really price assets properly. And, you know, markets need certainty. Then we can have an idea of where fundamental valuations should be, and then we can trade around those. Until then, unfortunately, it's going to be very choppy and volatile across assets.
Well, speaking of across assets, one thing I've been wondering about is, Matt, while you were here yesterday, Katie and I were talking a lot about gold.
It was a lot of fun.
It was a lot of fun, you know, for the people especially that are, you know, melting their gold jewelry.
I've got a ton under my mattress right now.
People actually do that. But at these levels, can that continue to be this much of a haven?
Yeah, that's a great question. I actually wrote yesterday about copper, which was being bid up as well because you can get gold out of copper. So smelters in China are actually incentivized to do that. So the gold trade is definitely looking like it can get some further traction as long as the uncertainty in America keeps the dollar under pressure. Obviously, gold is priced in dollars and people want to get out of U.S. assets. But it is overextended at this point, and I think we've talked about it in different things through MLive, where if we look at gold to silver ratio or we look at other sort of historical gauges, it is definitely overbought at this point. But with that said, the fundamentals still support it.
To be clear, I don't think we recommend doing that at home, melting copper to try to get gold out of it. But let's talk about a haven that hasn't been, and you mentioned the U.S. dollar. We've seen this big sell-off. It's reversing a little bit today, but what do you make of the sell-off so far in terms of market functioning? We throw around words like order, disorderly a lot. Where do we fall right now?
Yeah, I think it's been orderly, to be honest, and I think that's even more alarming because what it tells me is that people have accepted this fate that either the administration, the Trump administration, wants a weaker dollar and not to fight them, or that in general, the fundamentals for growth here are dictating that the dollar should weaken just on that. All of that means that this is probably in the early innings still.
I mean, the concern obviously is that normally investors in times of trouble flock to the dollar. Normally investors in times of trouble flock to treasuries, being that it's the most riskless asset.
The full faith and credit of the United States government behind them.
So is the idea maybe treasuries are not so risk-free? That's why I'm willing to pay so much more for gold versus silver than I normally would be.
I agree with that. I think that is being all questioned now. It's not only, again, the worry of where the dollar hegemony is going, whether it's a reserve currency because our trade balances are going to change, but also our fiscal situation, whether we're going to actually be able to effectively lower our fiscal deficit. Now, we've seen a lot of Doge talk and nonsense there in some ways because we don't have a set number of how much cuts are actually occurring. But overall, also on the tax front, if we go into a recession or a downturn, there's going to be less tax revenue. So all of our fiscal deficit worries are not going away by any means, they're only increasing.
Well, Matt brought up the concept that maybe U.S. Treasuries aren't risk-free. We had a conversation with Victor Hagani of LTCM yesterday, who basically made that case that Treasuries are trading like there's some degree of credit risk. He might be alone in that. And he says that, of course, U.S. Treasuries are still way less risky than stocks. But still, there's a lot of volatility at the long end.
Hey, listen. He lived it.
Yeah.
So,
he knows what not risk-free means as a founder of long-term capital management.
Uniquely qualified there.
He's been in the middle of that storm. Anyways, Michael Ball, we thank you so very much. Brilliant analysis as always. Learn something new every time, like melting your copper gets you gold.
There you go.
Less than 12 minutes to the opening bell. Stick with us. We're going to start the trading day with Citi's Stuart Kaiser. This is Bloomberg Open Interest.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Well, the strategist who called an end to U.S. exceptionalism in February is out with a new warning. SocGen's head of asset allocation says that a rotation out of American assets will continue potentially for years if Trump maintains his trade policy, with the dollar and Treasury bonds losing appeal. Citi head of U.S. equity trading strategy, Stuart Kaiser, joins us at the desk. Stuart, first of all, great to see you.
Good to see you. Morning.
So let's talk about U.S. exceptionalism, because that has been the popular narrative. It's been the popular trade, too, if you take a look cross-asset, that basically the U.S. financial dominance is coming to an end. Where do you fall on that debate?
I mean, I think it depends how you measure U.S. exceptionalism. I think for the last 2 to 5 years, U.S. exceptionalism has been two key things. One has been we've been out fiscally spending most of the world, and the second is we have a lot of large cap growth in tech stocks that really don't exist in other indices. Clearly, both of those are being challenged, right? I mean, if you believe in the Doge efforts, we're going to kind of, dial back fiscal, and then the growth stocks, are clearly kind of under pressure right now. So I think tactically, that's the case. How this kind of plays out over the next 6 to 12 months, we'll ultimately see. Clearly our economy is going to be impacted by tariffs. Is that going to be impacted more and worse than, let's say, Europe or China or others? I think that kind of remains to be seen.
It does look like President Trump is intent on putting tariffs on our trading partners, especially China. He wants to start and fight a trade war. He says trade wars are good and easy to win, right? With that in mind, can you really expect any kind of stability after 90 days? I mean, do you really expect any kind of stability from this administration next year or the year after seeing what they've done so far?
Well, I think China is a little bit of a separate case. I mean, I think what we're looking for is more successful trade negotiations with our key trading allies. And I'd put, Europe, India, Japan, South Korea, Australia into that category. I think if we see good progress there, that is good for markets, and I think that could be really supportive. China is a little bit of a special case because they use the term trade war as it refers to China, and I would not expect to see a huge rollback on China because the tariffs he put in place in 2018 did not get rolled back either. So I do think China's a little bit unique, but what we would hope to see is progress in other areas, and I think the markets would probably take that well. To your point, though, I mean, tariffs are higher now than they were at the beginning of the year, and at the end of this year, they're probably going to be higher, still.
Substantially higher.
Yeah, potentially. Yeah, substantially,
compared to what we've
exactly.
done. I want to talk about where people have been hiding. We've been talking about gold just a little earlier. This morning, gold hit 3,500. We have pared back since then, but it makes me wonder, to what extent is this as a haven trade starting to play out? I mean, what is the limit?
I mean, what the limit is, I'm not sure. I mean, I think our commodity strategists had a 3,500 target that they introduced less than a month ago, and we've gotten there already. So, clearly you can, kind of beat that to the upside, overshoot to the upside. I think if you look at how markets traded and were priced, you had TLT, which is long-term equity, long-term treasury volatility, and gold volatility, both significantly outperformed. They were actually up more than S&P 500 volatility in a 3% down day. So clearly people are either A, trying to hide in those assets, or B, viewing those assets as very sensitive to trade policy and inflation risks. And again, I would respect that. A couple weeks ago, our view was that gold volatility hadn't moved enough, and that was a place to hide. It does kind of feel like people are trading gold, though, as a dollar trade. I want to be short the dollar. I'm not sure what other currencies I can be long against that, so let me just kind of hide in gold. So I do think gold is a little bit of a haven. U.S. rates market, I think, is a little more up for debate, whether that's a haven or whether that's kind of a directional trade.
Yeah, hiding out in TLT sounds hard to do at this exact moment, but let's take this conversation to the options market, because you do see people grabbing protection in derivatives right now. There was a great story on the Bloomberg terminal how if you look at Magnificent Seven's put-to-call ratio, that you're seeing a lot of demand for puts relative to calls right now. And as we head into really the heart of earnings season, we have Tesla kicking us off after the bell tonight. Is that the trade to do right now?
To hedge Mag 7? Yeah. Look, I think the reason people are hedging Mag 7 is because they still own it. As much as people have backed out of that space, it is still kind of a core long position. So I do think you're seeing people, especially given the headlines we've seen on NVIDIA and in the chip space, kind of hedge that. If you take a step back on earnings, you've had about 50 companies report over the last month. Those that have either cut or withdrawn guidance have traded down 5% on earnings. Those that did not were up 1%. So clearly there's a huge focus this earnings season on how companies guide and if they guide. So, why are you seeing people hedge? I think just for that reason. They're worried that in that space you are going to see, headwinds to the earnings outlook. And as we've seen, that is not quote unquote priced. I think a lot of people say, is our tariffs priced? Is a recession priced? Is guidance down priced? The market is telling you it's not, because when we get new news in that area, those stocks sell off and the market sells off. So I think that's really what you're seeing is you've got a policy risk, you've got a positioning risk, and right now people are worried you also may have an earnings/capex risk. So you're seeing hedging in that space.
All right, these things take time. We're going to keep you with us today. Stuart Kaiser sticks with us through the opening bell. As we head into that, let's take a look at where futures are trading after the big drop that we had yesterday. Didn't close down so low. We were off 4% at one point and closed off just a little more than 2%. We're seeing the S&P off more than 1% right now. The Dow Jones Industrial Average, up more than 1%. Dow Jones Industrial Average up 427 points. The open on the other side of this break. This is Open Interest.
first time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley and LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trading on this Turnaround Tuesday. This is Bloomberg Open Interest. I'm Matt Miller. You are looking at futures climbing across the board. So S&P futures up more than 1%. NASDAQ futures up 1.3%. What do we have? Dow Jones futures. I like it. Katie, look at that. Up 450 basis points. And it matters. People are paying very close attention to the Dow because it has fallen from 45,000 and change down to 38. The opening bell at the New York Stock Exchange ringing at GE Vernova, and they're in a good mood, as they should be. Their stock is up 130% over the past 12 months. Down at the NASDAQ Stock Exchange, you've got People ringing the opening bell. They're not publicly traded, but they're owned by a company that's owned by IAC, and they're down about 43% over the past 5 years. Katie, what are the individual stocks you're watching as we bounce back a little bit from yesterday's drops?
Well, speaking of 43%, that's about how much Tesla is down year to date, and that's the setup heading into its report this afternoon. Remember, we know the company trying to navigate away from the brand damage that has been done by Elon Musk's work in the White House. And at least for right now, Sonali, the stock is up about 1.2%.
I got a down arrow for you, Katie. Northrop Grumman down more than 8.6% at the market open. They cut its earnings outlook for the year. Manufacturing costs rose due to a change in the production process.
All right, Verizon is another stock that we're watching right now. Lost more customers than expected in the last quarter, and probably more importantly to consumers watching, the CEO says if smart prices rise, and that's a pretty small if, consumers will absorb those costs. Sorry, smartphones. Did I say?
You said smart prices.
But smart prices.
Well,
Smartphone prices
over your brain
rise.
a little bit, isn't it?
I was what?
It's taking over the brain power a little bit.
Yeah.
Smartphones. We talk to it every morning.
I was over my skis a little bit in terms of the script there. Let's bring back in Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. And Stuart, we were talking about earnings. You know, we go into our morning meeting at 6 a.m. every day, and lately we're just waiting for the earnings calls because we know they're going to say, oh, uncertainty, oh, tariffs, you know, and really bring down their outlook. So what do you expect in terms of earnings growth this year? You know, 4 or 5 months ago, had we had this conversation, you would have said 14, 15% growth.
Yeah, it's much lower now. I mean, our U.S. equity strategists took down their EPS number to 255, you know, and you're working off about a $245 base. So that, cuts your EPS growth from like mid-teens to kind of mid-single digits. And, I think you probably have to argue there's downside risks, beyond that, because I don't think a lot of strategists at this point are fully factoring a potential recession. Not that that's our call, but I think that is kind of the risk to the downside. I think the question on this earnings season is what does management do? If you defend your numbers, you better have a very good reason, because I think there's going to be a lot of of critical thinking of why you're able to do that. And if you pull, I think the question is, does that clean up your stock and allow the buy side to really engage with it? And then the third option is just to either say nothing or pull guidance totally. And there, I'm not sure investors are going to respond very well to no guidance. If you guide down, that's one thing. If you pull it and say you don't have enough visibility, I think that kind of opens you up to a lot of risk going into earnings season.
I've been the person on the show that has been pulling up constantly the year-to-date performance of the Magnificent Seven, and throughout the year, it's been getting more and more bleak. It's pretty crazy. You are looking at these companies starting to report this week. You have Tesla tonight. You have Alphabet, Google later this week. You have news on potentially Amazon, according to Wells Fargo, pulling back on data center leases. I mean, can this get any uglier?
I mean, that's a lot of red bars, so it's hard to get too much uglier. But, I mean, look, it can. I think the CapEx guidance is going to be key here. There's already a lot of pressure on that AI trade, starting from DeepSeek and then moving on to other headlines we've gotten, regarding China, chip exports and things like that. So, look, the focus for Meta, for Google, and for Amazon is going to be how committed are they to that CapEx spend for this year, and probably also what are they seeing for CapEx spend to next year. And if they were to really, dial that back, I think you will see another leg lower in that AI-exposed trade. And, to Katie's point earlier, I think that's why people are hedging. It may not be your most likely outcome, but it is a very severe outcome if it happens. And as we've seen the last month, severe outcomes are not off the table.
Yeah, absolutely. They're the hot topic of conversation. So what do you do with all of that? I mean, I'm looking through your notes. You mentioned that, you're taking a look at what has lagged since April 2nd. When you boil down into the sector level, where are you finding maybe not opportunities, but at least places to hide out? Yeah, I think growth stocks is an area where we think you can hide a little bit. If you look at the PE damage done to long growth, the average PE of long growth stocks is down almost 30% since mid-February. And I think after that happened, what you've seen in April in particular is those stocks started to act defensive again. So coming into the year, tech and growth in particular, you had very high valuation and you had very long ownership. Both of those, while not completely fixed, have been addressed in a pretty significant way, and I think it's allowing people to kind of hang out there. So to the long side, I think growth stocks make sense, and I'm talking if you're like a 3-month type of investor. Tactically speaking, if you expect good headlines, I think you're just buying what's sold off the most because you're hoping for kind of a risk premium reversal. That's going to be weaker balance sheet stocks, it's going to be banks, and it's going to be semis. And again, that's not a fundamentally driven view, that's just I think I'm getting good headlines, what's been sold most might bounce. But our base case is still that lower is the path of least resistance, at least until you get down to around that 5,000 level on the S&P. And I think you just have to respect that that's kind of where the weight of the market is right now.
So you are the head of U.S. equity trading strategy. How many clients are calling you and saying, like, Stu, do you have the number for the guy who runs EMEA?
Look, it's a huge focus. I think that's been a focus all year. Like, how durable is this rest of world outperformance relative to the U.S.? I think the risk for Europe here is that they've outperformed by so much, and they haven't really caught the tariff bug, quite yet. And so those negotiations with Europe on tariff are going to be immense. If that initial tariff announcement is worse than expected on Europe, then the degree of outperformance you've seen, I think, is under threat. Frankly, since April 2nd, the DAX, for instance, has done pretty poorly.
By the way, are you not considering the possibility that we become a closed economy and the rest of the world continues to trade with each other? Because, Zero Hedge had a story yesterday, protectionism is good, and they were arguing for a completely closed U.S. economy.
That's where we are in the cycle.
Look, it's all possible. I think you have to ask your question, though, is trading with the U.S. with slightly higher tariffs worse or better than just being part of a global trade environment that excludes the biggest economy in the world? And I think the answer from the Trump administration would be no. Folks still want to have access, to the U.S. economy. If you're Europe and we tariff China and they start selling a lot of low-priced goods into your economy, what does that do to your economy? And is that an outcome you want? Because that is exactly the outcome that middle-class America has faced for the last 20 years that Trump believes he needs to resolve. I'm not endorsing that policy, but I think that's what's going on from a narrative perspective.
He wants higher-priced smartphones, right? I mean, $1,000 is so cheap for an iPhone. I wish I could pay $5,000.
Speaking of smartphones, this morning, Verizon CEO, as you were talking about, saying that those smartphone prices can pass off to the consumer. Given that we're in the thick of earnings season, there's a lot to worry about, and part of that U.S. exceptionalism story is part of that big tech dominance. I want to play Matt Miller, pull up a cool function on the terminal.
Nice.
I want to pull up SPLC for Google. This
One of my
is
favorites.
the supply chain, but I want to look on the right side, not the left side this time. The right side is who they sell to.
Keep pulling out.
Yeah,
Pull
out even more. Let's see what's happening on the right side here. So what we have here is Verizon, AT&T, T-Mobile as some of the largest players in the revenue space when it comes to what Google is selling to. If you're already hearing from Verizon and they're telling you consumers have to worry a little bit, and then Google is one of their biggest suppliers, how much do you have to worry here about if big tech starts to sputter, how much that impacts everybody else?
Look, I mean, I think that it also actually gets back to the CapEx discussion, which is who is that CapEx spent on? It ends up being kind of a little bit of a closed loop, right? You know, Amazon announces CapEx, that CapEx gets, you know, funneled through semis companies, and you get this sort of positive feedback loop. Well, you can also have negative feedback loops. So I think that is what people are worried about going into earnings, is if they pull back on CapEx, it creates kind of a domino effect, you know, that impacts spending across the entire complex. So again, not a forecast, but I think that is what people are worried about going into earnings, which is if you had this sort of positive feedback loop going up, do you get a negative feedback loop coming down? And if so, then, you know, a lot of the outperformance you've seen over the last 2+ years is at risk. Frankly, Mag 7 has given up 6 months of relative outperformance against the S&P 493. So there's already been a significant amount of damage done. The question going into earnings is there another leg behind that, I think?
Yeah, we'll find out and hope to speak to you soon on that topic as we get into earnings season. That is Stuart Kaiser of Citi. Thank you for your time this morning. Meanwhile, let's take a look under the hood because 9 minutes into the session, some pretty interesting movers on our radar. I want to pull up Kimberly-Clark. It lowered its profit expectations due to tariff costs. The stock is down almost 3%. Interesting move given that obviously they make consumer staples. You also have 3M maintaining its outlook, noting that tariffs add new risk to turnaround plans, but the stock is up nearly 5%. And then Boeing, we've been keeping an eye on, selling part of its digital aviation unit to Thoma Bravo for nearly $11 billion. The turnaround continues over at Boeing. Now coming up, Verizon in the red after losing more subscribers than expected. We'll take a dive into the wireless giant's first quarter next. This is Open Interest.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators.
Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission. It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back to Open Interest. A check on these markets with the S&P 500 at session highs right now, up 1.3%. It's big tech that's leading that index higher, and you can see that expressed in the NASDAQ 100. You have Tesla, NVIDIA, Apple rallying today, but it's actually the small caps, Matt Miller, that are outperforming. So I have the Russell 2000 up here, currently up about 1.8%. We're going to keep a close eye on this entire market, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, United Health getting downgraded over at HSBC. The analyst says that the company's profit warning caught him and the rest of Wall Street off guard. You can see the stock deciding what to do today. Next up, we have Macy's getting downgraded over at Goldman Sachs because of rising macro uncertainty and cyclical risk. And finally, we have Kraft Heinz getting downgraded over at Bernstein. The analyst says the company is seeing volume declines in its brands, including Lunchables, Kraft Mac and Cheese, Capri Sun, and Oscar Mayer.
All right, let's get a check on Verizon as well. The stock is falling after the wireless giant recorded a loss of nearly 300,000 monthly phone subscribers, and the CEO says consumers will absorb any price increases for smartphones. For more, we're joined by Bloomberg Intelligence senior telecom analyst John Butler. So I guess, you know, for the stockholders, the first concern is the loss of customers. What's going on there, John? Why are they losing customers?
So it happened early in the quarter, Matt, and that's the good news. What Verizon is doing is they're raising rates on some of their older, what they call legacy plans, not the latest unlimited plans, but those people like me, by the way, that have these older plans are seeing a price increase, and that's going to help them deliver on their growth promises for the year in terms of wireless service revenue. But it costs them in terms of people leaving Verizon when some people leaving Verizon when those price hikes came through. One thing they downplayed, but I think it was a big issue during the quarter, is it's a very promotional market. And I think what happened is we had some holiday promotions that spilled over into January and February, and Verizon is sort of a premium plan and premium priced wireless brand. Suffered from that carryover.
So if Verizon lost some customers, where do they go ultimately? And does it mean that Verizon has to react given that promotional environment that you've been talking about?
So that is a great question, and one thing that I think they should do, which is they should be a little bit more promotional, because the market here is maturing. The battle for subscribers quarter in and quarter out is getting more intense. And to answer your initial question, T-Mobile hasn't reported yet, but I wouldn't be surprised to see them emerge once again as the winner this quarter in terms of total what they call net phone additions, those smartphone users that jump brands, and T-Mobile tends to win during periods of promotion when you get a high degree of what they call switching activity.
John, I also want to get your perspective on something that was named for a reason why you saw fewer subscribers from Verizon, and that is less spending by government agencies. We know that the government in general, led by Elon Musk, has been trying to slim down, and I'm wondering how you think that this factored into the results we saw this morning from Verizon.
So the easy answer is it really didn't impact them to any great degree. It was visible in the numbers, and so they addressed it. What they alluded to were the Doge cuts and how they had an impact. And when you get seat loss like that, obviously, if If users had a government phone, those contracts get terminated as those people leave. So that's a trend that may continue, Katie, but I don't think it's going to be anything that's going to impact them in a big way going forward.
By the way, let me ask quickly, John, because I have a viewer writing about financing phones. If iPhone prices went from $1,000 or $1,500 to $2,000 or $3,000, does that matter to consumers since most of us pay for them monthly anyway?
No, I was just going to answer the question in that manner, Matt. I think even with a meaningful price increase, most people are financing their phones over 36 months. And so net, yes, they see a price increase, but they're not eating that, let's call it $1,000 increase up front. It's amortized over a 3-year period, and so much less painful.
We'll start taking 5-year or 7-year loans for our phones. John Butler of Bloomberg Intelligence, thanks very much for joining us. Now coming up, it's a busy day for deals from Boeing to Nomura. We'll have a roundup next in today's Wall Street Beat. This is Open Interest.
Global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We are seeing a rebound on the S&P, not recovering the 2.4% that we lost yesterday, or the 16% that we've lost this year. But we're up 1.4% there on the NASDAQ, up 1.7% as tech stocks put up bigger gains. And then the Russell 2000, the small caps, are the biggest gainer for those optimistic investors out there. In terms of the individual stocks that are moving, we're watching NVIDIA up 2% just because of the weight. Tesla up 3.5%. It's coming out with earnings after the bell, and we expect to hear some fireworks from Elon Musk. Lockheed Martin and Northrop Grumman both losing, although Northrop Grumman disappointing with earnings, getting absolutely decimated, and Boeing up 1% after announcing it'll sell a unit for $11 billion to Thoma Bravo. Sonali?
Private equity in play. And that brings us to the Wall Street Beat. Earlier this hour, Boeing announced that it will sell portions of its digital aviation unit to Thoma Bravo, as you've been saying, for nearly $11 billion. That is $11 billion in cash. For more on this deal and more M&A news, shockingly, that we're seeing this week, we are joined by Bloomberg's managing editor for U.S. deals, Liana Baker, our resident scoopster. And so, you think about this Boeing deal. You guys have earlier reported that it was happening. Thoma Bravo on a tear. Are they the only ones?
So they prevailed over other PE bidders, as we've reported, and there was also strategics circling this asset for Boeing, but clearly Thoma Bravo got this to the finish line. And as you mentioned, they're paying about over $10 billion all cash for this. And it's a way for Boeing to, pay down debt and try to fund their turnaround after all those, crises that have happened.
So we have Boeing, Thoma Bravo out today. I also want to talk about the news we got from Nomura yesterday, basically acquiring Macquarie. I never quite know how to say them, but biggest deal since Nomura bought Lehman Brothers. And it seems like it's a pretty big bet that U.S. exceptionalism maybe isn't going away anytime soon.
So it's funny because it's a Japanese acquirer doing outbound M&A to Australia, but it's a bet on the U.S. market.
Yeah.
And Nomura didn't pay a lot for Lehman Brothers back in the day, but they're paying over $1 billion for this asset. And it is interesting to see financial services deals make a comeback. Maybe these aren't super affected by tariffs, but we have seen other deals in payments and banks. That's an area to watch for sure.
It's Macquarie.
Macquarie.
I know Macquarie.
I'm going to stare in the mirror and say that to myself.
Like John Macquarie.
Yeah.
Macquarie.
Macquarie.
All right.
Macquarie.
We got more, though.
Yeah, there were 3 deals. Wait, we did Nomura, we did
Barrick.
Thoma Bravo.
Barrick
It's funny,
Yeah.
we've talked about the financial crisis or Lehman. So John Paulson was actually involved in this other deal. So we hopped on the phone with him yesterday. He's actually putting $600 million or $800 million into a big mine in Alaska. So he's a big backer of NovaGold, and they're buying out the stake which Barrick owns in this Donlin Gold project. And apparently Barrick is changing their name, I'm sure you guys know, away from Barrick Gold to Barrick Mining. This is part of that trend.
Then they have a lot of copper exposure as well, fun fact. Now, does this...
And what's the deal with copper? You say you can melt copper and get gold?
And
We learned
extract
that
some
from
gold.
Stuart Kaiser, yeah. If you're really desperate to get your hands on some gold, just find some copper.
Does this
Did not know
mean that there's actually a lot more coming? We heard from John Gray over at Blackstone. They said this is a moment to take advantage of. We saw KKR pull out their COVID-era playbook. Our sponsor is going to lead the deal comeback.
So we did see a pause with all the tariff drama, but it definitely was a takeover Tuesday today after a long weekend where it might have been slow with the holiday. But we're definitely looking at pockets of M&A. I mentioned financial services are busy. Private equity deals backed by private credit are very popular right now, but definitely there are things in the works and we're very busy.
Are people getting discount prices? Is now a time when people who had cash, dry powder as it were, going into the market and finding distressed deals?
We're trying to figure out, is it a buyer's market or a seller's market? I'd say Nomura today, if you look at the multiple in that deal, they feel like they were getting a good valuation there.
All right, Liana, great roundup as always. Obviously, you're a very busy woman right now in this deals environment. That is Liana Baker. Meanwhile, let's check on these markets right now. It's another day of pretty low volume, but this time into buying. You can see the S&P 500 up about 1.4%. We're close to session highs. We were higher by about 1.5% earlier. A lot of that enthusiasm is making itself known in big tech, specifically ahead of a big day later today with Tesla taking the earnings stage. The NASDAQ 100 up about 1.6%. And the small caps also up there, Matt. I don't know what the Dow is doing, but I would imagine
It's been a while since you've mentioned them.
Well,
they're coming back a little bit.
A little bit.
Baby bit.
The Dow matter. Did you guys see? I thought it was awesome. Torsten Slok usually puts out like one graph, one big paragraph, one thing. And on Friday he put this prediction out: 90% chance of a VTRR. A voluntary trade reset recession.
Yeah.
And he pointed out that small companies, so less than 500 employees, are worth 80% of the hiring and 85% of the CapEx.
I believe it.
And they get hit the hardest.
Driven the American
Friday
economy.
was a holiday, so I did miss that one. But
I'll forward it to you. Coming up in the next hour, Northern Trust Asset Management CIO Anwiti Bahaguna. Jan Hatzius of Goldman Sachs joins us. And then the points guy, the very tall Brian Kelly.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The International Monetary Fund is out with a report warning President Trump's tariffs will have a devastating effect on the world's economy. CBS News business analyst Jill Schlesinger.
For this year, the IMF projects that U.S. growth will be at 1.8%. That's down by 0.9% from the January forecast. Global growth is expected to come in at 2.8%, and that's down 0.5 percentage point since January.
The Dow is up 534 points at the open. Vice President J.D. Vance has met with Indian Prime Minister Narendra Modi in New Delhi, where the government hopes to avoid American tariffs by negotiating a bilateral trade deal.
He seeks to rebalance global trade so that America, with friends like India, can build a future worth having for all of our people together.
The White House says Vance and Modi set the terms for ongoing talks. The Vatican says Pope Francis' coffin will be moved from the chapel at his Santa Marta residence to St. Peter's Basilica tomorrow for public viewing. The funeral will be held Saturday morning. Then cardinals will gather to choose a successor. New York Archbishop Cardinal Timothy Dolan tells CBS Mornings.
They're going to see some mourning, they're going to see some gratitude, they're going to see some hope, and then they're going to see people say, we need to get to work. The Holy Spirit's already chosen the next pope. Our job is to find out who it is.
Palestinian activist Mahmoud Khalil helped his wife deliver their first baby remotely from a detention center in Louisiana. CBS's Michael Wallace.
Khalil's lawyers had asked for a 2-week furlough to New York so he could be there for the birth of his son, but ICE would only allow him to be on the phone with his wife. Khalil, who organized pro-Palestinian rallies at Columbia University, was arrested last month and deemed a threat to U.S. foreign policy.
The Supreme Court is hearing arguments right now in a religious rights case involving LGBTQ books in public schools. CBS's Jan Crawford.
A lot of parents were taking their kids out of the classroom. Now, parents on the other side say not only was it disruptive, but it also was divisive because, these books were supposed to be about inclusiveness. And instead, when parents were taking their kids out of the classroom, that meant it felt the opposite of that it was very divisive.
Beyonce's mom, Tina Knowles' new memoir's out today, and in it, she reveals a secret brush with cancer. Knowles tells CBS Morning she'd put off a routine mammogram during the pandemic.
It was stage 1, which I thought was the earliest stage. And then when I told my sister, she said, no, actually there's a 0. So if I had gone for my mammogram, I would have got it at the 0 stage.
Dow up 534. Bitcoin retakes 90,000. This is CBS News. In less than a month, you'll only be able to go through airport security or enter a federal government building if you have real ID.
A CBS News data analysis finds at least 16 states are less than 50% compliant with the law, which goes into effect May 7th. The TSA plans to treat that date as an all-hands-on-deck day because of the looming potential for disruptions at airport checkpoints. As of last week, New Jersey had the lowest compliance rate in the country. Just 17% of its state-issued IDs are real IDs. Pennsylvania follows, then Washington State and Maine. States mail the new IDs, but it can take up to 2 weeks to receive it. Matt Piper, CBS News.
Health Secretary Robert F. Kennedy Jr. is expected to announce more details today about his plans to phase out 8 commonly used food dyes found in everything from cereal to sports drinks. Some research has connected them to hyperactivity and neurobehavioral problems in kids. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning, live from NJIT, New Jersey Institute of Technology in Newark, New Jersey. I knew this place when I was in Newark School of Engineering. I know 2 graduates here when I was in Newark School of Engineering. Both of them super smart. Super smart. We got a lot of smart people coming with us today. The engineering, the technology types, the math people. You know, I don't interact well with them, but they're going to be some good people. We're going to learn a lot of good stuff here today from NJIT. We're going to start off chatting with Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. We had gold at $3,500 an ounce earlier today. We're at $3,400 and change. So that continues to move higher. We'll talk about that. Michael McKee, Bloomberg International Economics and Policy Correspondent. Get the latest on the economic outlook. The IMF cutting its outlook for global GDP growth. He's down in D.C. He's got all that stuff covered. Kathleen McGinnis, NJIT Assistant Professor. We're going to talk to her about some of the new approaches in cancer treatment coming up. So they're doing some really, really good, important work here at NJIT. We're going to be here for the next couple hours. But right now, let's go to John Tucker back in New York and get a Bloomberg Business Flash, John.
All right, hey guys, the Bloomberg Business Flash being brought to you by IBKR. Will U.S. initial jobless claims exceed 260,000 for the week ending May 10th, 2025? The yes was recently at 8%. You can trade your prediction with IBKR Forecast Trader at ibkr.com/forecast. Last trading day for this contract, May 14th. Well, after yesterday's market sell-off, stocks getting a lift today. All 11 major industry groups in the S&P 500 are higher. Consumer discretionary best performing group. The S&P 500 right now up 85 points. That is a rise of 1.7%. We're at 52.43 on the index. The Dow Jones Industrial Average up 630 points. The Nasdaq 100 up 355 points. That is a 2% pop right now. Well, the worry on Wall Street was still focused on the implications of any White House effort to replace Federal Reserve Chair Jerome Powell. Tesla reports first quarter earnings after the close of regular trading today. Meantime, Victoria Fernandez at Crossmark Global Investments says, you know what, volatility should force investors into more defensive stocks.
You're not quite sure which story to believe, and you have to determine whether you think soft data is going to bleed into the hard data. And if so, then you would expect some of these areas of the market, the more defensive areas of the market that are leading now, to continue to lead.
And right now, some of the leaders in the S&P 500 in terms of index points. First Solar, those shares up 13%. Equifax up 11%. And Invesco almost 11% higher. Northrop Grumman, one of the worst performers, laggards in the S&P 500. Those shares right now down over 12%. They cut its adjusted earnings per share guidance for the full year. Guidance missing the average analyst estimate. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. And that's your Bloomberg Business Flash. Now back to NJIT, Alex and Paul.
All right, thanks so much, JT. Really appreciate it. Alex Steele here alongside Paul Sweeney. So we have the overall equity market, the NASDAQ 100 sort of rising a good 2 percentage points right now, 2 session highs. We're also getting a lot of earnings coming out from some industrials as well as consumer staples like Kimberly-Clark as well as 3M. Let's take a look at some of those stocks on the move today. We're joined now by Bloomberg's Vildana Heinrich. All right, let's start with Verizon. What happened here with subscribers?
Yeah, we have Verizon Communications reporting a larger than expected decline in mobile phone subscribers in the first quarter. And what the company said is that this is the result of very heavy competition. As we know, the space is highly competitive, but also less spending by government agencies. And so we have shares sliding. I think this is interesting because we have sort of the reverberations from the Trump administration moving to slash thousands of jobs, as we know, since the president took office. And so now you're actually seeing that coming to fruition for one of the companies.
That's interesting. I wonder that competition, too. It's just there's only so many cell phones one will have. And let's get to the main event. Let's be honest. It's Tesla. Yep. After the closing bell, I was just reading a headline that there were some governors that sent a letter to the board, started talking about Musk's role in the government. Like, are we expecting fireworks today?
Well, this, as you said, is the company that everybody's watching. We talked about it yesterday as well after one of its very prominent analysts said the company is facing a code red moment, and we have Tesla reporting earnings later today. And what people are looking for is for Elon Musk to actually inject some excitement potentially on today's earnings call, given that we have the drop-off in sales and obviously we have a drop-off in its stock price. The year is off to a pretty bad start given Musk's political entanglements. Tesla sales have fallen to a nearly 3-year low in the first 3 months, and so what a lot of analysts and a lot of investors are looking for is potentially for Musk to actually inject some of that excitement on today's call. I know we spoke yesterday about whether or not he's going to be part of the call. He will be on the call, or he's expected to be on the call. He has actually only missed one earnings call in his time as CEO.
And I should point out, Paul, it was treasurers of 8 U.S. states sent a letter to the board, but they're addressing concerns, so it holds.
It does. And I think, if you think about Tesla, the stock forever has been tied to Elon Musk. It's Elon Musk is Tesla. Tesla is Elon Musk. Talk about key man risk or key executive risk. You could argue that's the greatest company out there as an example. So Dan Ives at Wedbush Securities again yesterday calling out again for Mr. Musk to put his focus back on the company. Kimberly-Clark, what did they have to say today?
Yeah, diaper maker Kimberly-Clark is cutting its profit outlook, and this is due to tariff costs. So we have the company lowering profit expectations for the year, and they're citing uncertainty arising from the impact on the global trade war on its costs. So we have the chief executive officer saying the current environment will now mean greater costs across our global supply chain versus our expectations at the beginning of the year. So it just goes to show you how quickly things can change in a matter of just a couple of months.
All right, thank you so much, Vildana. Really appreciate that, Vildana Heinrich, joining us from Bloomberg Equities. For more conversations just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the market. Listen to Stock Movers on Apple, Spotify, or anywher you get your podcasts. It's a day that ends in Y, so commodities are doing something interesting. You get crude up by about 1.5%. Gold at one point hitting at another fresh record high. Only one man to speak to, Mike McGlone. He's senior commodity strategist at Bloomberg Intelligence. Mike, are we at a blow-off top here when it comes to gold?
Yes, it's putting in some pretty good peaks. I just went back and compared the best years of gold from the last 100 years, and this morning gold was ranked 7th. Guess what year was behind? 1934. 1934 is significant because that was the year after we devalued our FDR devalued versus the gold and confiscated a lot of gold. So we're in a very scary area for gold. So this is pretty good resistance, 3,500, pretty good level to watch for. It could easily drop down to 3,000, but overall, it's a signal that I'm getting from gold is this is the deflation from the inflation we got from the biggest money pump in history to that peak in 2022 in the stock market and things. Now it's all starting to trickle down. So I'm worried that gold is going to make back up a little bit, but it's giving us signals of a great reset, the things that some of us wrote about a couple of years ago.
So, again, I think I asked this question a lot, Mike, and I'm trying to get a handle on how people think about valuation of a commodity like gold. Do you just, if you're a gold bug, you buy it? If you're concerned about the world, you buy it? If you want to take some more risk, maybe you sell it and buy some other stuff? Is that how you think about it?
Yeah. Well, the gold bugs, I think, are more the kind they buy it and hide it. In their underwear drawer. I mean, they have to be able to touch it and hold it and put it someplace. But the thing I think that's the most significant thing for gold is its ratio and its correlation and connection with the U.S. stock market. So one thing I've watched forever is the ounces of gold that are represented by the S&P 500. So right now, before we broke down, it basically took 2 ounces of gold for one S&P 500. Historically, it was really high. And now it's breaking down to about 1.5, and historically it's closer to 1. So I think we're heading towards that 1-to-1 level, particularly with Bloomberg Intelligence expecting the S&P 500 to get to near 4,000 in the case of a recession. So it might be a good meeting place. S&P 500 gets to 4,000, gold gets to $4,000 an ounce, and they meet back at 1. Historically, that's the place. So that's the number one. But bottom line, the key thing is it's really hard to value something. Like I said, a key thing I want to point out about gold that really changed this year. Before we had central banks buying, in the last 4 years, ETFs were net outflows on gold. But this year, we have significant inflows in gold ETFs, up almost 10%. And I think that's a shift in investor sentiment. They're realizing, okay, there's issue with bonds. We all know the stock market's probably peaked. We're heading towards recession. Buy some of this rock instead of stocks. And so far, that's the case. But it's just getting a little stretched here at today's high, around 3,500 an ounce.
How long has he wanted to say?
I know.
By rock versus stock. I think a pretty long time. Hey, Mike, we talk a lot about oil. We talk about gold with you. What's the thing in the commodity market that's most on your mind right now?
Well, definitely gold. The key thing I've been watching that I've really been somewhat flummoxed by is copper. Copper's already had a good year. It started around 4. It pumped up to $5.37 a pound. That's a new high for the year on the back of tariffs. It dropped back to 4, and now we're around $4.80. I think on a global basis, certainly as you see as downward revisions of global GDP and what's happening with China and the rest of the world facing tariffs, I think copper's more at risk of going back towards 3 than staying above 5. It really hasn't done yet, so it's staying pretty resilient. But I don't know if we want to put it in the same category, but technically Bitcoin's classified as a commodity by the CFTC, and that's the one that's really been showing somewhat divergent strength lately.
Yeah, the kids don't talk about Bitcoin as much as they used to.
Oh, they do. No, they totally do.
Okay.
I mean, just listen to Katie, Tim.
Okay.
They totally talk about it.
Yeah. All right.
Is it moving as a safe haven, Mike?
Well, it has been, shockingly, because in my view, people claim it's a safe haven, but it trades at much higher volatility than the stock market and gold. But I think what's really kicked in lately is this distress in the U.S. bond market. People are saying, okay, if we're having a problem with issues with the world's safest securities, mostly long bonds. Maybe let's go to Bitcoin. The problem I see with Bitcoin is it looked like it put in pretty good peak last year at $100,000, and we're seeing outflows now the last 3 months, some inflows recently, and I think the key things people are realizing is that whole crypto space is a much higher correlation to the stock market than risk-off assets. In short term, right now at 90,000, it seems more of a bit of a feint, and I think the risks are if stocks start rolling over, that the whole crypto space does the same, and Bitcoin is in that area of risk on now.
Yep. We got Bitcoin. It's up $3,000 here. That's 3.6%. 90,400 for Tom Keen's cryptocurrency there. So keep an eye on Bitcoin. That's Mike McGlone. He covers all the commodity stuff from pork bellies to Bitcoin. He covers it all. He goes out to Indiana and he watches farmers plant crops. That's how down in the weeds, literally, he gets. Mike McGlone, Bloomberg Intelligence Commodities. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages are all up over 1% after yesterday's sell-off, with the trading volume pretty low right now. For instance, the S&P 500 volume 23% below the average this time of day. Among the most actively traded ahead of its earnings report after the close, shares of Tesla, they are rising right now, up about 4.1%. Since its peak in December, though, the stock is down 50%. The treasurers of 8 U.S. states who oversee investments, including shares of Tesla, they've written an open letter to the board of directors of the company expressing concern about Tesla's direction and Elon Musk's level of attention to its challenges. Aerospace and defense giant RTX shares, they are lower after the company said tariffs stemming from President Trump's trade war pose a significant risk to operating profit. RTX shares right now down close to 8%. Right now, the S&P 500 is up 89 points, a rise of 1.75%. We're at 52.48 on the index. The Dow Jones Industrial Average up 693 points, and the Nasdaq 100 359 points higher. That is up just over 2%. Two-year yield up 3 basis points. That's at 379. The 10-year, that's down 2 basis points. That's at 439. And the price of gold right now has come off the high, 34.39, up about 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Now, back to NJIT, Alex and Paul.
All right, thanks so much, John Tucker. That's right, Alex Steele here alongside Paul Sweeney. We are in Newark, New Jersey at NJIT, New Jersey Institute of Technology. 13,000 students enroll here, and we're talking about architecture, design, engineering, liberal arts, computing, management, and an honors college. We're going to talk to some of the amazing professors and assistant professors throughout the next couple hours. We do want to keep you updated on what's happening on the economic front and in Washington, D.C. And for that, we go to Michael McKee, international economics and policy correspondent who's in D.C. And the IMF just released its lowered forecast for world growth this year and next, citing the risk of a global trade war. Also saying, Mike, the possibility of recession in the U.S. is rising to 40% from 27% in October. What else did we learn?
Well, Alex, the World Economic Outlook is rather cloudy indeed, according to the World Economic Outlook. Basically, the IMF had to retool all of their forecasts that were underway when Donald Trump announced his tariffs on April 2nd. And so since then, they've come up with a couple of different scenarios because we don't know what exactly he's going to do. But the one they're using is one they call the reference scenario. And it is that the global growth rate will fall by 0.5 percentage point this year. But inflation won't rise as much because global slowdown will mean that price pressures ease a little bit. That's for the whole world. For the United States, it's much grimmer. We will grow just 1.5% this year. That's almost a full percentage point less than had been forecast just 2 months ago by the IMF. And the inflation rate will rise to 3% as unemployment rises above 4%. So the U.S. outlook is not particularly good. And all of this they blame on tariffs.
So, Mike, that's kind of where I wanted to go here. I mean, it does feel like a switch was thrown, 3 months ago where we were in a decent economic outlook, GDP, growing in a 3% range on a real basis, inflation probably still a little higher than the Fed liked it, but, 2.5%, stock market at all-time high. Is the IMF, are they ascribing, as you mentioned, the majority or all of their cuts to this uncertainty surrounding tariffs?
Yes, and to modeling out the tariffs themselves and what impact they might have. Of course, they have to just sort of pick a level of tariffs and try to come up with an estimate for what that might mean, since we don't have those numbers. But basically, they're working off what the administration had announced in early April. And it's just an across-the-board drop in economic activity, GDP, markets, everything. And, of course, as you mentioned, they do put a lot of weight not just on the financial costs, but on the costs of uncertainty.
What areas through the IMF's forecast were maybe the least affected by all of this?
Interestingly, of the major economies, Great Britain is the least affected. They don't see really any change in growth for the UK. They forecast 1.7%. That's down just 0.1%. And they don't see any change in UK inflation, 3.1%, or unemployment, 4.5%, largely because the Trump administration didn't really put much in terms of tariffs on the UK, just the 10% universal tariff. So they got off a little bit easier than other countries. The Eurozone sees a decline in growth of 0.5% to just 0.7% this year.
Hey, Mike, does the IMF opine at all on the duration of tariffs? A lot of folks are saying, hey, if President Trump backs off or waters down some of these tariffs like he oftentimes does when push comes to shove, or he delays them, that maybe the impact won't be as bad. Can the IMF even model that out?
Well, they try in the sense that they're doing a couple of different scenarios, and they do a lighter tariff regime. And so, which would mean that the impacts are lower. There's still an impact, but they're lower than the reference forecast. But they make no predictions about how likely any of these are going to be.
When we take a look at other areas of the global economy, what did the IMF say on China?
Well, that's really interesting, Alex, because the Chinese take a big hit. Growth of just 3.2%, down 1.3% from their January forecast. That would be the lowest growth rate in China in decades. The Chinese government is aiming at 5% this year, so it could be a big hit to the Chinese in terms of inflation. They think they'll be flat. That's maybe the best case scenario for China in this situation. A lot of people think they would experience disinflation, if not deflation.
Mike, we're going to get some economic data this week, initial jobless claims. I mean, what are you looking at this week to try to see those initial signs of economic impact in what we like to call the hard data?
Well, you'd be looking at things like jobless claims, which haven't moved at all. They've actually come down some, so it doesn't look like companies are letting people go. But this is a kind of a different scenario because we're in an environment coming out of the pandemic where companies couldn't find workers, so they are more reluctant to let people go, more reluctant to adjust in the face of a potential recession than they might have been in the past. Next week we'll get the March jobs report and the April jobs report, rather, and that will give us some indication in the unemployment and labor force numbers of what's going on. If immigration, illegal or otherwise, has basically fallen to zero, the labor force won't grow. It should probably shrink. And so that's something to keep an eye on as well.
All right, Mike, super appreciated down in D.C. there. Michael McKee, Bloomberg International Economics and Policy correspondent. And of course, we get a ton of earnings out today. It was quite interesting. 3M, for example, maintain their outlook as tariffs.
Do you know what 3M stands for?
MMM?
Minnesota Mining and Manufacturing.
I did know that. I did know that. Somewhere in the recesses of my brain. I did know that. But you had the CEO also talking on the call that potentially they would look into possible product shifts and looking into customer surcharges, so like how to pass on that tariff risk. All right, in the market, you're getting the dollar index, Bloomberg Dollar Index, up a touch today after hitting a 3-year low yesterday. Vincent Signorella, Bloomberg macro strategist, joins us now. Hey, Vince, have we seen the bottom for the dollar short term?
I don't, well, I mean, short term, maybe this week. I think we're just looking at a little bit of a relief rally across the board, both in equities and the dollar. We've had a really hard sell, obviously, in the last, in this entire month, if you will. So a little bit of bounce, you know, isn't shocking. Can't wait to see how this tape closes at the end of the day. If this rally will hold, if we see this rolling over going in weak into the close, it's going to be a very, very bad sign for bulls, I think.
So, Vince, from your perspective, talking to traders on the street across various asset classes, who's been selling this past 3 or 4 months here?
Who's been selling? It's not retail.
It seems like everybody.
I was just going to say, who's not selling? I think the only
who's not selling? Maybe that's the question. Yes.
Right.
I think who's not selling are retail. I mean, they're still of the buy the dip. Although when I talk to individual investors, I'm starting to hear, starting as of yesterday, getting some serious panic in some folks about their, these are like family offices, not the bigger sort of places, and the family offices probably hearing from their individual investors, and feeling a little panic in their voice about, is there the same question you just asked? Is there a bottom to this? Where is it coming? And it's hard to predict. I mean, we're nowhere near any resolution to the trade situation. We still have, the White House digging in their heels, and then yesterday China upped the ante by basically saying to the world, if you do a deal with the United States, don't come back looking for a deal with China. If it in some way, shape, or form your deal with the United States hurt us. So basically putting the countries of the world on notice that they have to choose between the U.S. and China. And that's an amazingly difficult choice for countries to choose from. On one hand, you've got, cheaper imports. And on the other hand, you have the might of the United States in other areas, even when it comes to defense. Like, I don't know how you make that choice, to be honest.
So when you're on the IB, and that's sort of the instant messaging for the Bloomberg terminal, what are clients asking you the most? Is it the dollar? Is it the sell-off in equities? Is it a safe haven pet play? What's been your biggest takeaway?
That is an amazingly good question, because it's kind of a little bit of everything. But I think the dollar is almost a back burner question, to be honest, because I think traders see that as just a result, the effect, if you will, of what's been going on, not the cause. The cause is, again, that tariff story. We're seeing a major sell in dollar risk assets. And if you look, you'll see it just from the dollar. You see it not today, but in treasuries as well. In certain other areas of fixed income. Watch the credit markets and see how that plays out. We're seeing some companies come to issue this week, and I think we're starting to see major corporations come to the market looking to do some issues, getting ahead of what I think the perception is interest rates will be higher and the cost of raising capital will be higher. Again, even crude futures is a big deal, I think, on traders' minds. We're seeing a bit of a rebound today, but it's been a good sell-off on what is thought to be slower global economic growth. So you look to what commodities are going to weaken if you see this trade situation continue, and that would be crude. And then you look at gold touching 3,500, which, briefly, of course, but, phenomenal rally in an asset of a haven asset. So markets clearly still worried about the haven story.
All right, Vince, thank you so much. We appreciate it. Vince Signorella, he's a macro strategist over there at Bloomberg News. Coming up, Wunmi Sadik, NJIT Distinguished Professor, Chemistry and Environmental Science, on the development of nano-sized analytical sensors for measuring pain. So that's kind of a cool discussion. Looking at the markets here, we're higher, so not a lot of pain here today in the stock market, up 1.7% on the S&P 500. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages higher but low volumes today. You have all 11 major industry groups in the S&P 500 up right now. Consumer discretionary, that is the best performing group. And that is home to Tesla. Elon Musk company set to report earnings after the close of regular trading today. Tesla shares right now up 3.6%. That's off the best level of the day. The lift we're seeing today comes after the market slide that we saw yesterday after President Trump threatened Federal Reserve Chair Jerome Powell. And Dan Morris at BNP Paribas says Fed independence is absolutely critical.
The reason, the argument that you want to have independent central banks is that you don't want the central government, the federal government of any country using monetary policy to promote their own, normally a growth agenda, because the concern is going to be is over the medium term you're going to end up with higher inflation.
Right now the S&P 500 96 points higher. That's up 1.9%. The Dow Jones Industrial Average up 737 points. The Nasdaq 100 up 387 points. That is a rise of 2.2%. Kimberly-Clark reporting quarterly organic sales. It disappointed. They also said the company faces about $300 million in incremental costs because of the Trump tariffs. You have shares right now of Kimberly-Clark, the diaper maker, down 2.25%. And then Danaher climbing, the life sciences firm reporting quarterly profit. That beat estimates. Danaher shares are right now 4.9% higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Now back to Alex and Paul at NJIT.
All right, JT, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We're live here at New Jersey Institute of Technology. That's NJIT to the cool kids. I'm going to stop by the store and get some swag, I think.
Okay.
The sweatshirts.
For the whole team? Or?
Yeah. No, I think I'm just maybe get a sticker for the car.
Harsh, man.
Yeah, we're here in Newark, New Jersey, and some smart people here doing some really smart research, and we have one of them next. Wunmi Sadiq, distinguished professor, chemistry and environmental science here at NJIT. Wunmi, talk to us about what you're working on in terms of your research here. I see the BioSmart Center. That sounds pretty cool. What are you guys doing at the BioSmart Center?
Thank you so much for having me. At the BioSmart Center, our goal is to look for sustainable materials in terms of chemistry to create technologies that will help people. One of our technologies actually to detect pain. Over 100 U.S. adults live with chronic pain. And more than 10 million individuals struggle with prescription medications. But every time you go to the hospital, and the clinicians, physicians are required to measure pain. And the only way we do that, despite advancement, is to show you a facial scale.
Yes. Yes.
They wear on the scale. Like, what faces are you right now? Exactly. So what would your research be able to do?
So basically my research says pain is biochemical in nature. And when you have chronic pain, there's a lot of inflammation. And when there's inflammation, there are chemicals, there are biochemicals that are produced by the body. By measuring, first of all, by knowing those biochemicals and measuring how much they are, we can relate this to pain that people are feeling. And so you won't need the subjective approach to measure pain. Because if you have infants, for example, if you have elderly, if you have people who are unconscious, they're not able to articulate their pain. And so you can actually use our biosensors, our smart biosensors, to give you the level of pain that people are going through.
So where are you in terms of your research these days?
Our sensors are being used currently. We have collaborators in upstate New York, and they take human blood samples and they measure the levels of molecules called cyclooxygenase 2 or inducible nitrous oxide synthase, and they measure the level. We combine this with artificial intelligence.
There we go.
To be able to give you the exact amount of pain that people are going through. And for the most part, we've been able to link the level that people suggest to the level that we're measuring from our biosensors.
How far are we from like regular doctors and nurses using it in hospitals?
Currently, I mean, we've looked at close to 1,000 individuals, and we're getting 80% accuracy in terms of what people tell you. At the end of the day, pain is also individualistic, right? There are aspects of pain that it depends on individuals. You have
it's tolerance, right?
Exactly. Yeah. You have saturation. So there are so many other components that will impact it. But in terms of being able to actually test this out, we're doing this already.
So how does doing research at a place like NJIT, how does that work? How do you balance, research with teaching and all that? Because I know most professors have to deal with that across various disciplines.
In actual fact, there's correlation. Because in the classroom, I teach graduate students. I teach them the fundamentals, and then we take it further from the classroom and actually do this in the lab. And so there is a connection between what you do in the classroom, what you teach in the classroom, and what you actually do in your lab.
We talk a lot on Bloomberg here about tariff risks, about economic risks, about products being in short supply. Is any of that relevant to the work that you do? Like, are you worried about getting certain materials or products to fund and continue moving your research along?
Certainly, we're going to be affected because, as you know, most research at the moment are funded by the federal government. And so if there's less funding, there's less time, they will not be able to support students to be able to do the work. And so ultimately, it will impact our research. It would impact the classroom and what we do.
What's the next step for you in your research? Are you working with a team, other professors, maybe other universities? What's your team look like?
My team at the moment, we have 6 PhD students. We have postdocs. We have clinicians that are working with us. We have computer scientists who are looking at the AI component of our work. So it's a whole center activity.
How did you come to research this particular part? I always find that really fascinating when you narrow it down. The field must be so broad, right? Why measuring pain?
That's a very good, that's a very good question because I have always developed sensors for different things. We develop sensors for the environment. We develop sensors to measure different things. But I had a friend whose daughter was suffering from sickle cell. And she asked, many times she's in crisis. Physicians are difficult, they cannot really assess whether or not she's in pain. And I thought, well, that should be easy. As long as we can find a particular molecule, we can measure that. And I thought somebody should have done that.
It seems so obvious. No, I'm kidding.
But we did. We looked in literature and we realized it's actually not. And this is where we started the work 15 years ago.
And are doctors, clinicians in the marketplace, are they receptive to your research and what in your products?
Clinicians are receptive, but my own daughter is an anesthesiologist.
Okay.
She's a physician, and she's at Hopkins. And she says, Mommy, if we can find an instrument that would tell us how much pain people are in, this is going to be significant because we get a lot of people coming, they say they're in pain. We're required to treat their pain, but how can we actually assess how much pain they're in? So if somebody says I'm 10 out of 10, who are you to say they're not?
Right. Yep, interesting.
Well, really great stuff.
Yep.
Congratulations on all of it. We wish you a lot of luck. It seems like an amazing, amazing research that you guys wind up doing here. Thank you so very much.
Thank you.
That is Professor Wami Sadiq joining us, NJIT Distinguished Professor of Chemistry and Environmental Science, on measuring pain.
Yep. I never thought about it. I thought it was, again, just a little...
But the inflammation thing, that's so key. I feel like everything wrong with us is inflammation related. But what do I know? She's nodding that I said that. So therefore, it must be real.
Exactly. All right, we're holding the gains here this morning. S&P 500 up 1.9%. I'm going to quote the Dow for John Farrow, up 750 points. That's 2%, of the NASDAQ up about 2.1%. So holding on to those.